So let's start, guys. Let's start. Okay. Now, first, let's start with our basic definition as to what is accounts. Okay. So, if you understand this definition, no, you'll understand. If you're able to understand this definition, you'll understand the whole account. That is how it is. Okay. Just see. Accounting is an art of recording, classifying, summarizing various transactions that are monetary in nature, and thereby analyzing the financial position and communicating such results to the users of such financial information. Okay. Now, first is an art. Art and art, kale, is an art of recording. Recording what? The transactions that businesses do on a daily basis. So, how will you record these transactions? Where do you record? In which? Via? Exactly. So, first you'll record the transactions via journal entry. So, in this definition, recording means journal entry. Second, then all these transactions you will classify. Where do you classify? Via what? Ledger. Exactly. No. What will we do in ledger? We take all the accounts that is used in journal entries. Correct. For every account that is used in journal entry, we create one ledger. So what are you doing here? Classifying each and every account. Is it very important? Yes. Because what is journal entry? Journal entry is recorded on a chronological order. Okay. Many transactions which is happening on time basis, we are recording it. Suddenly one day, owner will come and he'll ask, hey, how much is the balance payable to our landlord? And then suddenly ask, what will you do? Will you open journal books and one by one, next will you do this, right? It'll take again 1 hour. So what will you do? If it is classified in form of ledgers, then you can directly go to landlord ledger and you can directly find out the payable. Oh, this much amount we have to pay. Done. So classifying is very important to get the meaningful information. We classified, then summarizing. So summarizing, where do we do summarizing? Exactly, in final accounts. Now there will be many rent transactions. Rent you would have paid 12 times in a year. Salaries you would have paid to many people. But in P&L, in one line, salaries, you come to know what is the total salaries paid, what is total rent paid, what is total depreciation. So everything is summarized and put it in the format of final accounts, which is your P&L account, trading P&L account and balance sheet. Correct. So that is your summarizing various transactions that are monetary in nature. So this means anything that can be measured in terms of money, only that can only be brought to books of accounts. Something which cannot be measured in terms of money cannot be bought. Remember, there is also called as money measurement concept. Correct? Anything which can be measured. Now, say suppose I have an employee. That employee is very much honest. I thought not even for a single time he has thought of even stealing something from my shop. Now, is that my asset? Technically, if you think like normal, like father mother mentality, it's an asset only. No? You can aram say go outside. You can leave this guy in the shop. You can spend time outside. But can you record that in the books of accounts? No. Why? Because it cannot be measured in terms of money. Hey, he's so good that he's 5 lakh rupees good. He's so good that he's 5 lakh rupees good. Since it cannot be measured in terms of money, we cannot bring it to books of accounts. So that's why they have told that are monetary in nature and thereby analyzing the financial position. So when you do all this and when you ultimately summarize the transaction in the format of final accounts, that is P&L and balance sheet, what do you understand from P&L and balance sheet? The financial position. Similarly, say suppose guys, accounts is actually, you know what it is, common sense only. Now imagine, how will you, say suppose you're seeing me for the first time. Now tell me, how will you analyze my financial position? You don't know anything. How will you analyze?
The way you dress.
Exactly, the way I dress. Then you'll see my assets, my car, my bike, iPad, all this you'll see. Correct? You're seeing my assets. You should also see my liabilities. Then only it will match. So when you see both assets and liabilities, they are able to judge my financial position. Similarly, that's why we see the balance sheet of the company to understand the financial position, because what it contains, assets and liabilities. Simple. And ultimately, after doing all these accounts, final accounts and everything, someone should be there not to read it. Someone should be there. So we'll end up communicating this to the users of such financial statements. So who are users? Can you tell me? There can be two kind of users. One is internal, one more is external. Who are internal users? The management of the company, CEO, directors. Why do they look at the financial statement? Because they have to do decision making. To take a better decision, they should know what is happening, what is the present situation of the company. That's why they will see. So we can see here, if you see all the CEO, management level, senior level managers, employees, all three of them come to same thing only. They are internal. Why are they seeing? Maybe why are the lower level employees seeing the financials? Maybe they have to prepare some management information reports for the purpose of higher authority. That's why they are referring to accounts. Correct? So they'll use. Then the next set of users are external users. Who are external users? As they said, shareholders. Shareholders, why? Because they have invested their money, they want to invest their money, they should know what is happening to the company. Then we have government. Why? Because tax calculation depends on the income of the company. I thought there will be one percentage. We apply that percentage on income. That income should be correct now. Then only tax will be correct. So government. Then customers. Why will customers see our financials? Hey, what customers should invest? Customers means they are buying from us. They are in that capacity.
Whether they can provide a good quality.
That will be reflected in financials. You should directly check the material. Why? Simple way. Now, if I am purchasing something from one of my supplier, then my supplies to my customers is dependent on whom? This guy, no? He should constantly supply to me. Then only I will be able to supply timely to my customers. Someday if this guy becomes bankrupt, what will I do? Then my goodwill will go down because I am not able to give products to my customers timely. Correct? So whenever I am selecting my supplier, I should see. Now to my supplier, who am I? Customer. So whenever I'm selecting my supplier, I should be careful. Is this guy solvent? Does this guy have enough money? Will he run away? All that information, where will I get? In my financial statements only. Correct? No, that's why a customer will also use the financial information. Then government over.
Bank.
Yeah, bank will also see. Lenders. We can put them in the lenders. Why? Because they are giving their loan. Same concept. No, it should have the capacity to repay it back. How will I judge his repaying capacity? Via financial statements. Correct? No, then we have potential investors. They'll come to shareholders only. Now, if you have to, potential investors means those who want to invest, but they have not yet invested. How will they judge whether this is a right investment? By looking at financial statements. Then we have government done. Competitors. First of all, they are people of Indian mentality. We want what is happening in other states. So competitors, of course, what they do, they want to know what is happening, what competitors are doing, how they are performing. How will they know that? Directly by referring their financial statements. Correct? No, that's why. So communicating this information to all these users is the purpose of the account. Correct? All of you? Now you know. If you understand this definition, no, you know accounts, because everything is there on recording journal. Accounting is an art of recording, classifying, summarizing, and analyzing and communicating the financial information to the users ultimately. Correct? And only those transactions which are monetary in nature, right? Because non-monetary things cannot be bought. Then we have then all this is repeated. So I'll focus on the important parts, guys. Okay. As you know, we have this limitation of time. So let's understand the advantages of accounting. Okay. What are the advantages? One by one, we'll start part of it. It helps to maintain systematic record of transactions and thereby proper control over financial figures. They are telling systematic record of transactions. So why are they using the word systematic? Now, whenever we are maintaining accounts, whenever we are recording, how are we recording? There is a process, no? There is journal, ledger, double entry, accrual, everything. There is a process. That's why it's called systematic. Simply you are not taking 2 ludos, you are not doing like this. Inga put accounts ಮಾಡ್ತಾ ಇದೀರಾ ಇಲ್ಲ ತಾನೆ. There is a proper process. So that's why it's called systematic record of transactions. Then it helps to ascertain financial position. This we have already discussed. Accounting helps in understanding financial position. Then it will be made available to users of the financial statements. Correct. Next, it enables us to compare the results within the company. This is very important point. Correct. Once you have your financial statements in hand, that is your balance sheet and P&L, what will we do? Pooja? No. We will compare it with other companies, or we'll compare it with previous year performance. Correct? No. Either we are comparing it with previous year's financials of our company only to know how is our performance, or we are comparing it with other companies to know where we stand. Correct. So comparability is one of the very important features of accounts. Then financial statements. I mean, next, it serves as an evidence to any legal situations. Is it, guys? How will this serve as an evidence? Let's say, suppose I'm a lender. I'm a lender or I'm a receiver, anything. So since someone has given me money, it for me it is what? It's a liability. That liability I would have shown in my balance sheet as liability. Then when CA would have come, he would have signed, checking that whether this liability is correct or not. Later, that guy will come and ask me money, and I'll be like, who are you? I don't know. He'll directly go to court. In the court, he'll say, sir, I've given him money. This guy is saying, who are you? Then court will be like, give the evidence. Sir, no evidence, sir. I've given him in cash. Then what to do? Then that guy, what he'll do is, his financial statements is there. He'll bring it. Sir, see, sir, in that year's balance sheet, he's showing me as liability. That means what, sir? That means he had taken money from me. And CA has also signed it. So don't you think the financial statements is acting as an evidence in the court? That is one of the advantages of the accounts. Clear? Next, limitations of accounting. What is limitation? Disadvantages. So first one you already know. Accounting considers only quantitative aspects and not qualitative. That means anything which can be measured in money only can come. Qualitative, that cannot come. Next, maintaining records and books is like a postmortem job. Postmortem, what they mean is, you will not get any futuristic information from accounts. The only thing you can get is whatever has happened. If I ask you sales, you can tell me only the sales that has happened. Can you tell me what sales will happen in the next year from the accounts that you have prepared? You can forecast. That's a different thing. But can you accurately say, sir, this is the sales that we'll do? No. So that's why they are telling accounting is a postmortem job. You cannot get futuristic information. Next, accounting results can be easily manipulated and misled. Yes. All books of accounts, journal, ledger, all this we have. Correct? It is easy to. Have you seen scam? 99. Easy to rub. Make 5, 6 and manipulate everything. People will not know. So that risk we have. That control we don't have. If some guy makes some error or if he wants to cheat us, then it is easy in accounts. Okay. Now the systems have become much more better. Now this problem we don't have, but they're talking about the earlier scenario. Okay. Back then, since everything was manual, it was easy to manipulate and cheat. Now it has become very difficult to cheat and all. Okay. It ignores time value of money and inflation. So by now I assume that you know what is time value of money. What is time value of money? Hey, you're an account student and you're also maths student. Maths is over, no?
Yes.
You'll be having time value of money. What do you understand?
Interest. The purchase order.
Hey, the inflation. Then I should only tell. Okay. Then I should only tell. So time value of money, guys, it is a pakka Marwadi thinking. Time value of money means Marwadi thinking. How Marwadi thinking? Money is never idle. Money is always earning. You have not invested, that's all. But money will always earn. You have to properly invest it or lend it to someone, it will earn. If you are keeping inside the locker, it will never earn. So, simple. Today I will invest 40,000 rupees in a bank. After 1 year, that 40,000 will earn interest and it will become 50,000. Now what I will say is, 50,000 is the future value of 40,000 rupees. And 40,000 is the present value of that 50,000. Clear? Money is never idle as per. This is a very normal Marwadi concept. Money is never idle. We are keeping it idle. That's all. Okay. Considering that opportunity cost of interest that the fund can earn, money can earn, is called your time value. Now, what will happen? Say, suppose you show something as debtors. What they are trying to tell here, I'm trying to tell. Say, suppose you're showing something as debtor, and the debtor is supposed to give 5 lakh rupees. Okay, when will you give? Say, suppose, just to make it easier, say, suppose the credit period that you have allowed is 1 year. Assume. That means this guy will pay after 1 year. 5 lakh rupees. Now tell me, as per your present value, future value concept, today's 5 lakh and the 5 lakh that you will be receiving tomorrow, same?
No.
No. Is your account showing that present value? No, you'll simply record it as 5 lakh. But what is the true value of that 5 lakh? Is it exactly 5 lakh? No. You are receiving this 5 lakh after 1 year. That means the present value will be much more less. For example, if you have 4,50,000 today, it will become 5 lakh after 1 year. That means if you are getting 5 lakh after 1 year, means you are losing out on that interest. That's why the value of that money today is lesser. Is account considering this? No, it will directly record it at 5 lakh rupees and it will receive 5 lakh. So is account considering time value of money? No, that is one of the limitation. Is it considering inflation? No, what is inflation? Decrease in purchasing power of money. Earlier, when I was doing CA foundation, for 100 rupees we used to get 4 masala dosa. Now we are hardly getting even one. Why? Because the value of money is decreasing. Is accounts taking into consideration of this inflation now? It will simply record at whatever price we purchase or sell. Is it considering inflation? So it's not considering time value of money or inflation. That is one of the limitations. Then estimates used in the accounting might not always be correct. Do we use accounting estimates in accounts? Do we? No. We use. Where do we use? Any examples that you can give? Many places we use. You give me one example. In depreciation where? Sorry, yes, thank you. I'll take it. In depreciation, where do we use?
Types of methods.
First of all, depreciation itself is an estimate. Right? Why are we telling depreciation itself is an estimate? Because while calculating depreciation, what all will you use? Let's take an example of SLM method. What is the formula for SLM method? Cost minus scrap value divided by useful life. Now, scrap value is what? The value that you are getting at the end of useful life. How do you know it today only? Because it's an estimate. Useful life, you pakka know this iPad will come for 15 years. Pakka do you know? Then how come you are dividing it by 15? Because it's an estimate. So like this, and your PDD, provision for doubtful debts, 2% of debtors will do. And they are estimating now, mostly this year 2% people will not give money. So what are you doing? At all these places you are doing estimate. Since accounts involves lots of estimates, do you think you'll get the accurate results? That's why that is one of the limitation of the accounts. Here. Then comes bookkeeping. So what is bookkeeping? Differences between bookkeeping and accounting we have to understand. Bookkeeping means only recording of transactions. What was accounting? Accounting is summarizing, classifying, recording, all that was there. But bookkeeping is only recording of transactions. So which is bigger? Which is bigger? Accounting is bigger. No, accounting along with recording, it is doing other things also. It is doing classifying, it is doing summarizing, communicating, everything it is doing. So accounting is a bigger term. Bookkeeping is subset of accounting. Correct? No? So let's see the other differences. Bookkeeping is just recording of transaction. Accounting also does summarizing and everything. Next, bookkeeping is base of accounting. Is it? Only if you record all the transactions, then you can do summarizing and everything. So for accounting, bookkeeping is the base, first step, recording. Accounting is the language of the business, correct? No? Since it communicates profits, assets, and liabilities, people are able to understand business via accounting. That's why it's called as language of the business. Next, we have, can managerial decisions be taken with the help of bookkeeping? No. How will bookkeeping? Bookkeeping is only recording. Some 20 books will be there where you have recorded the transaction. Now, if a CEO comes, what he'll see all the 20 books one by one, and then he will do decisions. Not possible. Only when information is properly summarized and communicated, then meaningful decisions can be taken. So, if bookkeeping summarized, no, that means we cannot take managerial decisions. It is just recording. But in accounting, can we take it? In accounting, properly we have given all the assets, liabilities, rent to expense, everything we have given properly. Now, from this, they can take correct decisions. Correct? Next, financial position of the business cannot be ascertained through bookkeeping. Correct? Because we have not summarized it. But in accounting, we will come to know about it. Done. Next. So, in this, I will discuss about only three things. That I come to contingent asset. Okay. So, wait, what is contingent asset? Contingent liability. This is something which depends upon an asset or liability which depends upon a occurrence or non-occurrence of some event. Right? These are called contingent assets or liabilities. Best example that we can take is, say suppose we are a company, I'm a company. Some other guy will put a legal case on me. Right? Simply, he has put, this guy has not done the work properly, 50 lakh rupees damages he has to pay. Right? Some other company has put a case on me. Now, he just put a case. Do you think I have to pakka pay to him? No. When will it become actual liability? When the court gives the orders. Correct? Now, until then it is contingent. It depends on the event. On what event? On judge giving the order. Correct? This is the best example for contingent asset or liability. Now, for me, this is what? Contingent liability until the judge gives the order. Correct? All of it. Now, let's see the definition. First, contingent liability means what? A possible obligation. Generally, when you see a liability, no, it is probable. If you see here, here it is not there. Generally, a liability will be probable obligation. Okay. Then what is probable? Probable in there for the purpose of accounts, more 90 or more than 90% chances. And more than 90% chances are there that I will satisfy the obligation. Then that's why it's called probable. The chances are more than 90%. What is obligation? Obligation is a duty to do something. It's a duty to do something. Say, suppose you have taken money from someone. Okay. It is the duty. It is your duty to repay him the money back. That is your obligation. Aita? So obligation is duty to do something. In case of loan, it is duty to repay. Correct? So liability is generally a probable obligation. But if you see, if you come to contingent liability, they are telling it is a possible obligation. So possible means what? Possible means, guys, it is 50% or more chances. Probable is 90% or more. Possible means it's a 50% or more chances are there that there is an obligation. Why? Because it depends on that court order. No? That's why the chances became less. Correct? It's a possible obligation that arises from past events. What is past event? Something would have happened between you and that company. Because of that event, today that guy has put a case. That is that past event. The occurrence or non-occurrence of which depends upon an uncertain event. What is the uncertain event in our example? Court order. It depends on that order, no? After that order, this possible obligation will become probable. Correct? And is it in the control of the company? What? Can the company go bribe him and make the order towards company? No. Not in it. It is, no. It is very, see, whenever we are doing assumptions, no, we should do assumptions normally. You know, we have something called as prudence in accounts. You remember? Anyway, we'll be brushing up on that. So whenever we are doing assumption, no, assumptions should be normal. We'll read about it. Okay, I'll come back to it. Okay, we'll come back. See, you have the not correct assumption now. Think what happens in the majority of the cases. Will all of the judges can we bribe them? No. Majority. Only some people are there what to do. Now can we consider them for our assumptions? Not correct. We should take the majority part. Correct. No? So that is contingent liability. So what is contingent? A possible obligation arising from the past events which depends upon an occurrence or non-occurrence of a certain event which is not in the control of the company. So this becomes your contingent liability. Now let's read contingent. A probable or a possible receipt. Sir, what sir? Here they have used both. So probably you already know. More than 90% of receiving the asset. Possible means 50%. So they are telling, be it probable, more than 90% agreeably. Be it possible, more than 50% agreeably. In the future, that depends upon occurrence or non-occurrence of uncertain event, which is beyond the control of the company. So if you see in liability, they told only it is possible only. The chances 50%. But in asset, they are telling possible or probable. Why? They are telling even if it is probable, but if it depends on a occurrence of some event, don't record it. They are telling why? Because of your conservatism concept. What does conservatism concept say? If it is today's loss, if it is future loss or foreseeable loss, book it off today. But if it is an income, don't touch it. Correct? Now they are telling asset is what to us? Asset is in the nature of income to us. Liability is in the nature of expense. Only expense can be liability. No? So they are telling contingent asset, even if it is probable, but if it is depending on an event, don't record. Conservatism. But liability, even though if it is possible, record it off. Because foreseeable losses, first you should show it. Understanding of why they have included both in contingent asset and not in contingent liability. Understood? So even asset. Now say suppose what is the example for contingent asset? Same thing. Same example. Think from that company's side. If the court orders and if the company gets 50 lakhs, then for that company it is a contingent asset, which has put a claim on it. Right? Even though if it thinks that the winning of the case is probable, will it record? No. But if it is depending on an event, it will not record. Why? Conservatism concept. So that is about your contingent asset, contingent liability. Now let's come to provision. What is provision? They are telling it is a present obligation. Obligation is what? Duty to do something. And they are telling present. What is present? Present is existing on the balance sheet date. And as on today, it should be payable. Okay, it should be payable. When will it be payable? Maybe you have used the services that is given by someone, and now you are obligated to pay. That obligation should be there. If I ask you, hey, are you supposed to pay me? Yes, sir. I've taken your services. I'm supposed to pay you. This is what? Present obligation. As of today, I'm supposed to pay you. In my balance sheet, your liability is appearing. It's a present obligation. Whose occurrence is probable, under more than 90%, and also can be measured with substantial degree of estimation. Now the thing is, if you see, the provision definition is as good as liability. Then why have they bifurcated provision and liability? See, come here, if you see liability, what is liability? Okay. Items which create future economic benefits outflow. Okay. Don't you think liability is also a present obligation? Yeah. Today we have to pay it to some person. Okay. Is paying of the money probable in case of liability? Yes. More than 90% chances we have to pay them. 90% and 100% we have to pay them. Then how come it is bifurcated? The only thing that differentiates provision and liability is provision involves estimation and liability does not involve estimation. That is the one thing. Both are liability only. But if you know the amount correctly, it becomes liability. If you're estimating the amount, you don't know the correct amount, then it becomes provision. Understood? Huh? So that's why they have told it is a present obligation, it is probable, and it can be measured with substantial degree of estimation. Guys, for something to be provision, it should not only be estimated, the way to estimate it also should be reliable. Properly, it should be estimated. Okay? Then something which cannot be properly estimated at all. We cannot estimate. There is a liability which cannot be reliably estimated. What it becomes? Exactly. If you see, contingent liability had one more line. A present obligation which cannot be reliably estimated becomes a contingent liability. A present obligation which can be reliably estimated becomes provision. A liability which we already know the number, that is called liability. Contingent liability, first of all, two things will come to contingent liability. One is it's a possible obligation arising from past events which depends on the occurrence or non-occurrence of some event which is not in the control of the company, or it is a present obligation but which cannot be reliably estimated. It becomes contingent liability. Provision means it is a present obligation which is probable and it can be reliably estimated. That is a provision. Clear? So, sir, do you want to know the example of provision? Sir, provision for doubtful debts is a good example. Hey, what did I say? Provision is a liability but cannot be estimated. That's all. No? But that should be estimated. Do you think provision for doubtful debts is a liability? Think about it. What is provision for doubtful debts? See, what is happening as per your conservatism concept. I'm assuming you know what is that concept because we have that time limitation. Conservatism andre ajji thinking. Ajji thinking. You know what is ajji thinking? Say suppose girls will be knowing. If girls are wearing some sleeveless and all, ajji will be like, hey, no, you are not supposed to wear. Because ajji think, conservative thinking is very low with respect to all this. That's why we call ajji is a conservative. Correct? No? So when you are an accountant, you should be very conservative. Andre, when there is income, no. Guys, better example to understand conservatism is, okay, I'm explaining it now only. Best example to understand is ourselves. Okay, say suppose all of you have done second PUC, when you have done with your exam, okay, you have done it very well. The moment you come outside, when your friend asks, hey, Magai, exam engai tundra you? The second question, no. Illa Maga ಸ್ವಲ್ಪ ಕಷ್ಟ ಇದೆ. Just pass on. They would have done very, correctly only. They would have done a good job. They would be like, stay. Say suppose there is one question which he has done wrong. That he will tell. Hey, that's wrong. 5 marks. Near pass or fail. But if he has done something well, he will not tell. Correct? No. This is exactly conservatism. When you are an accountant, when there is income and all, you will not do. When there is a foreseeable income, you will be like, let it come, let it realize. Then I will record. But when there is a loss, you will first book it off. This is exactly your conservatism concept. Okay. Now, what I was telling? I was talking about provision. The provision for doubtful debts is what? As per conservatism concept, you are foreseeing the loss. What loss? You are thinking that next year one of our debtor can become bad. That's why today only you are booking. You are creating that loss today only. Provision. Is this a liability? Then you are all of you telling it is an example for provision. So it is one of the biggest truth that you should understand now is provision for doubtful debts is not a provision, is not this provision. Because for something to be a provision, it should be a liability. That is provision for doubtful debts is adjustment to assets. Adjustment to assets. See, whenever bad debts happens, actually debtors will go down. But whenever you are creating provision, should the debtors go down? No. Why? Because actually bad debt has not happened. So what will we do? To some account we have to put it. We'll put it to provision for doubtful debts. Adjustment to the actual asset. Okay. It is not the provision as per this. Biggest lie that we have, people have taught us. That provision different. Because for something to be a provision, it should be a liability. Okay. So correct example for this is provision for tax. Yes. That is a correct. Why? Because we are closing the accounts on 31st March. We don't know the exact amount of tax that we pay. Correct? We are estimating. So that's why. Do we have reliable way of estimation of tax amount? Yeah. Why not? You have tax laws. You know what is the tax law applicable to that year. You have CA sitting. If you ask them, they'll tell you how much tax you have to pay. That much provision you can make. Correct? No. There is a reliable way. Or what you can do. Previous year, if you have done the same level of business, and this time also you have done same level, then the tax amount should be somewhere around that amount only. So there are reliable ways to estimate. So provision for tax is a proper provision. Okay. Now for your CA foundation accounts purposes, wherever provision comes, that is provision only. But this is what I'm telling is actual accounts. Okay. Now you are starting with accounts, so that is fine. So all of you understood the difference?
The provision for depreciation is that
No. Technically, is it a liability? Just think, you only think. There's nothing to ask also. Is provision for depreciation, is it a liability? Are you supposed to pay money to someone in provision for depreciation? No, then it's not a provision. Okay, technically, this is the truth. What you're doing. Generally, whenever there is depreciation, asset account should go down. That is first method, where you'll also credit asset account. In the other method, what you do? You cannot touch asset account, so you're touching provision for depreciation. So that is also adjustment. All your depreciation is getting accumulated there. So that is also not provision as per this definition. Because for something to be provision, it is a liability. It should be a liability. You only see. It's an obligation, and they have only told. What provision for depreciation is an obligation. Provision for doubtful debts is an obligation. Is there any duty to do something? Okay. So that is about these three things. Let's next come to net worth. So what is net worth? How will you understand a net worth of any individual or any company business? You take all their assets. He has so many buildings, full of car, all that he has, jewelries and all. But you should also consider his liability. What if everything he has funded by a liability? Then zero net worth. Correct? No. So whenever you're considering a net worth of a person, you have to consider both asset and liabilities. So take all his assets, subtract all his liabilities that he has, all the loans and other stuff. Then whatever is remaining, that is called net worth. Most famously, as per our accounting equation, you can also say capital is equal to assets minus liabilities. All of you agree with this equation? Huh? So if you remember your balance sheet, here we'll have plus capital with. And you should know that this is the reflection of this. This you will be knowing, correctly. So we are just altering this equation. So capital becomes assets. This goes here, minus. That's all. This is the most famous equation. This is very important. We'll be referring to it mostly throughout our discussion. So what else you should know? The other parts we'll understand later. This is very important. You understand trade discount, cash discount? What is the difference between both?
trade discount is sure in books and tax discount is not sure.
Exactly ulta you told. Ulta. So trade discount is not shown in the books of accounts. Cash discount is shown. Okay. Trade discount is what? The discount which is given at the point of the supply. Now say suppose you come to my shop. Okay, want to purchase this phone. Okay. The MRP of this phone is say 75,000. Then 5,000 he'll give you discount at that point only. Now the net price is 70. Okay. At the point of supply only your cost became 70,000. Why will you carry discount and all to books of accounts? Directly put purchase in 70 only. Enough. Because at point of supply only you got the discount. So that's why trade discount is the discount which you get at the point of supply that you will not record in the books of accounts. What is cash discount? That you get at a later rate. That means you have purchased the goods and say suppose it's a credit sale. Okay, you are supposed to pay money after 3 months, but you will pay in 2 months. Since you are paying the money early, I am offering you a discount. This is called cash discount, and this is happening after purchase. So this you record because earlier you had recorded at a wrong price. Now you record the discount. But if you are getting discount at the point of supply, then what is the point in recording? Directly record the net price. So trade discount is not recorded in the books of accounts, but cash discount is recorded. Then, very important is your capital revenue. This is very important from your exam angle also. Sometimes they might ask you a 5-mark question also directly as to classify whether it is a capital or revenue. Okay, so very important. Okay, this is a very important discussion. All of you focus. So what do you understand by capital or revenue? There are two kind of things which we learn here. Okay. First we'll learn capital expenditures and revenue expenditure. So before understanding the bifurcation between these two, it is very important to understand what will happen if something is a capital expenditure. You know what is expenditure? Spending of money. All the capital expenditures will go to balance sheet, and all the revenue expenditures will go to P&L. Okay, that is one important bifurcation. Okay, what is the example of capital expenditures? Purchase of furniture. Okay, whenever you purchase furniture, will it go to P&L? No. What will be the journal entry? Furniture account debit to cash. So it is directly going to balance sheet. Nothing is coming to profit and loss account. Okay. Example of revenue. Rent. Correct? Will rent go to P&L account?
Yes.
It's an expense. It will go to P&L account. So therefore, it's a capital expenditure. So, it's a revenue expenditure. Correct? Now let's understand the different points which is used to bifurcate whether something is a capital or revenue. So first intention, first reason, you have to see the nature of the business. Okay. Is it important? Yes. Now say suppose, I'll ask you, you tell me whether it's a capital or revenue expenditure. Will it normally go to P&L or balance sheet? I have sold my furniture. Or I have purchased my furniture. Okay, I have purchased furniture. Okay. Tell me. Aita. Sure. What if I am seller of furniture? Correct? No. If I am seller of furniture, then it becomes what? It becomes my normal purchases, because of which it will go to revenue. Huh? Sorry? Yeah. See, say suppose I am a purchase of furniture. In normal cases, it is capital expenditure. Say suppose I am a dealer of furniture. My business is only to sell and purchase furniture. Then my purchase of furniture is not in the nature of capital. It is in the nature of normal business. So it will become revenue expenditure. Purchase and the revenue expenditure. It will go to P&L. There. So first thing that you have to see is nature of business. Okay. You're understanding now how nature of business is altering. If my nature of business is only is to sell and buy furniture, then purchase of furniture cannot become my capital expenditure. It will become a revenue expenditure. So first thing, see what business they are doing. Based on that, you bifurcate. Second, frequency of transaction. Tell me, will capital expenditures happen for more number of times in a year or revenue expenditures? Take an example of rent. Rent you'll pay for 12 times in a year, but purchase of furniture, what every once in a year maybe, or not even once a year. Correct? No. Will you purchase it for every month? So next what you have to see is frequency. Right? These conditions you have to use it. I thought these conditions are not conclusive. Conclusive means final. If it satisfies this condition, that means it is a capital expenditure. That's a conclusive rule. These are guidance. You can use these rules to think about it, but ultimately the professional judgment should be made by you only. You can use this as a guidance. Is it conclusive rules? No. You can only use this as a guidance. Then frequency done. Third one, increase in economic efficiency. So this thing you should generally use in the stage of substantial. What do they say? Expenditure with subsequent expenditure. I'll tell you what it is. Whenever you are doing subsequent expenditure, you have to use this rule. What is subsequent expenditure? Say suppose you have already bought one machinery. You have already bought. It is already there in your premises. Now, rupees 10,000 rupees you have spent on this machinery. Now my question is, for whatever, repairs or enhancing it or whatever it is. Now my question is whether is it a capital expenditure or is it a revenue expenditure? Is the question.
Why does it enhance the life of the...
So the question, whenever I ask you whether it's cap or revenue, the question you have to ask yourself is whether it increases the efficiency of the machinery, of the asset. If it is yes, it's a capital expenditure. If it is no, it's revenue expenditure. Okay. So generally this rule applies whenever it is a subsequent expenditure. You have already taken the asset and on the same asset you are expending some money. Generally, whenever those questions come, you can use this rule as a guidance. Okay. Increase in efficiency means what? That we have to understand. Increase in efficiency should either lead to two things. Thing number one, it should increase your revenue or profit. Either it should actually increase your profit, one, or it should either increase your capacity to earn profit. Two things. For example, let's take an example. Now, say suppose we had space. It was full khali. What we did is we already had a building. Later, what we did is we invested some money and we created more classrooms. Now, tell me, is it a capital expenditure or revenue expenditure? We had only khali space. We had only 4 classrooms. Later, we invested much more money and we made total 8 classrooms. I've invested 5 lakh rupees for this. Tell me, is it a capex or a revenue? Capex. Why?
You can take more classes.
See, two things. Is it actually increasing your profit?
Yes.
How? If students come, then profit will increase. Just because I'll increase 4 classrooms today, will you get me admissions? No. So first condition gone. It is actually not increasing the profit. But second, is it actually increasing the capacity to earn more profit? Yes. Now you can take 8 classes together. You have the capacity to earn more profit. So it is a capital. Either it should increase your profits or it should increase the capacity to earn more profits. Both will qualify to be capex. Okay. That is your increase in efficiency. Next. Revenue generation, very important. So what is revenue generation? So one of the major reasons why we bifurcate capex and revenue is this, in my opinion. In expenditure, do you get any benefits? Do you remember what was the definition of expenditure? It is a spend on which you'll get benefits, economic benefits. If you spend some money, you get economic benefits. Asset is what? Asset is a resource held by the entity from which future economic benefits are expected to come into the entity. In both cases, you are getting economic benefits. Then why bifurcation, asset to expense? Is both asset and expense spends only, expenditures only? Why it became asset? Because it is classified as capital expenditure. Capital expenditure is, say suppose there is an expenditure. You'll first bifurcate. If it is revenue expenditure, it will go to P&L, it's called expense. If it is a capital expenditure, it will go to balance sheet, it's called asset. Both are spends, both are giving you economic benefits. Why two different names? The only thing it is becoming two different names is because the benefit that you are getting from expenses is for less than 12 months. That's why it will go to P&L. Because in P&L, what do you record? Benefits or incomes only for 1 year. That's why it will go to P&L. But in asset, what is happening? You're getting benefits over many years, more than 12 months. If you purchase a furniture, you'll get benefits from furniture for more than 1 year. Okay, that's why it is becoming asset. That's why they've used the word future in that definition. Future economic benefits. That means you're getting economic benefits not only for present period, but also for future period. Understanding what is the one thing that made asset and expense two different things? It was that period. Less than 12 months, it is expense. More than 12 months, it became asset. Now, same thing here also. If you have done some expenditure and you are getting benefits for less than 12 months from that expenditure, it is revenue expenditure. If more than 12 months, it is capital expenditure. That's all. Materiality of the amount involved. So, what is materiality? Say, suppose materiality is, there's something called as materiality concept also. Okay, what is materiality? Any information which influences the decisions of the users of the financial statements. If I knew this information, my decision would have changed. If that information can change my decision, it's called material information. It need not be in terms of money only. It can be anything. Okay. There's also called as one concept, materiality concept. So what they're telling is, as per that concept, we'll understand material word better now. Okay. So what is material? Anything which can influence the decision of the users. Let's take an example of user as shareholder. Okay. Now I have invested in that company. I'm invested in that company. Now there is an information. The information is there was a director of the company who was trying to shift the profits of that company to another company. How? He has created one more company. Okay. He's doing the buying from that company only at a higher price. Because of which because of which that company is making huge profits. Understanding? Okay, no need to understand the example also. This director has the intention of cheating. Why? Because he's trying to shift the profits from this company to other company. But he's actually not done. He tried to do it. But he has actually not done it. But we have come to know the internal management. This guy he has another company. He's trying to shift the profits, but he has not yet done it. Now tell me, is this information material?
Yes.
Why?
So that I can take my decision whether to invest.
Will it, if I am an investor, will this influence my decision?
Yes.
Yes. If I come to know that the company in which I have invested, that director is a fraudulent fellow, then do you think I'll keep invested?
No.
So I'll change my decision. So this is a material information. Any information which influences my decision is called. What influenced you to go outside the class? No. Simply. Okay. What was I telling? Materiality. So you understood now what is material. Anything which influences the decision. Now, while deciding whether something is a capex or revenue X, okay, you do all this capex revenue X drama only when the money is material, that is bigger. If it is an expenditure of 2 crores, 3 crores, and my turnover is 100 crores, okay, it's material amount. I'll do all this headache. I'll apply all these rules. I'll do all these divisions. Good. Say suppose it is 20 rupees. And I'm doing all this with the capex or revenue XR, nature of the business, materiality. Is it worth my time? So what they are telling, for material amounts, do all this. If it is immaterial, no, okay. Put it to P&L only. That doesn't matter. Miscellaneous. Don't do all this for 20 rupees. If it is some 2 crores, 3 crores, do it. Correct? Huh? Next. All the expenses incurred to make an asset ready to use. This is last criteria. Say suppose you're purchasing or constructing or doing some asset. You're purchasing or constructing some asset. Say suppose it's building or machinery or something. You're purchasing. To purchase you have paid some 5 lakh rupees. The accounting standards are saying that whatever expenses you have incurred on the same asset which you have acquired until the stage of until the stage of that asset becoming ready to use, all that expenses should be capitalized and it should go to balance sheet. How will it go to balance sheet? Because you add it to the cost of the asset. Since you add it to the cost of the asset, it will go to balance sheet. So they're telling not only that purchase price, all the other expenditure which you have incurred on that asset to bring it to your location. Now say suppose you are buying a plant and machinery. It is 5 lakh rupees. I bought it. Then from his place, from a supplier place, I have to get it to my place. So for porter, I'll give on 2,000 rupees. Then I have to get it installed. Is it ready to use it? No. I have to install it. Then I have to do testing. After this, it is ready to use. So till this point of ready to use, whatever expenses I incurred, can I put it to P&L? No. I should capitalize to the cost of the asset. So all the expenses which have incurred to make the asset ready to use, these are capital expenditures and not revenue expenditures. While adding it, not all the expenses which you are incurring should count. Only all those expenditures which are directly attributable should count. Andre, for example, say suppose you have bought the plant and machinery. Meanwhile, your employees have gone out for vacation and you have paid money. Will you add that also?
No.
Hey, no. Only those which are directly attributable to the asset. Sir, how to understand whether something is directly attributable? For this, I have one famous rule, okay, which I tell in my classes. Okay, for those who know Kannada, they'll understand. It is called Neenu illade nanilla. Neenu illade, it's a romantic phrase in Kannada. Okay, without you, I'm not there. In English, in Kannada, Neenu illade nanilla. So you should see whether this expense is Neenu illade nanilla. Andre, the expense should be of such nature that if you had not purchased the asset, this expense should have not incurred only. If you are incurring this expense only because you have purchased this main asset, that's why it is directly attributable. At this test you have to apply. Now tell me installation. Is it Neenu illade nanilla?
Yes.
Yes, because if you had not purchased, then no question of installation. What about the transportation? Yes, correct. No? Say because of this machinery, you have got this new electrical wiring system done. Is it directly attributable? Yes. Yes, no. Because of the asset, you are getting it done. Without asset, you would have not got it done only. Correct? No? So, you should do this Neenu illade nanilla test. It should be directly attributable expense. Then only you can add it to the cost of the asset. It becomes capital expenditure. So, all of you understood? These are the different rules that you should know when you are classifying. Now, let's take some examples to classify this. Okay, fast. Pata we have to do.
Sir, if I add all my direct expenses consider all my direct expenses as capital expenditure and put into my assets, will not my face value of assets increase?
Of course, it increases. No doubt about it.
Will I be judging my asset for that value only then?
See, at that value only. See, I'm understanding your question. So you're telling, since we add it, the asset, the valuation of the asset is going high. Don't you think it is wrong? We are showing it that way. No. See, how the valuation is decided. Okay, this you have to understand. You'll understand at a later stage. Okay. Now, if I have to give you an idea, valuation is not exactly, based on the price of the asset. And for example, this iPad. The market price of this iPad is say 80,000 rupees. If I'm showing it at 1,20,000, that is your problem. Sir, this is only 80,000. How come we are showing it at 1,20,000? Isn't it wrong? See, when I capitalize something as an asset, I am making money. Now, me as a CA, I am making money out of this iPad, not by selling this iPad. By using this during my lectures and making money. That I can make. When you see the valuation from that perspective, it is correct. Why am I ready to invest so much? 80,000 plus 40,000 I've invested for accessories. Why? Because I know that I'll be recovering much more than 1,20,000 rupees from the iPad. That's why I invested. Okay. So what we'll do is, we'll not only take the direct valuation, we'll also take how much I will earn. This is called as value in use. You'll understand at the later stage. As long as it is within that limits, it is correct. Or else, if it is much more than that limits also, then we will bring it down. It is called impairment of assets. You learn at the higher level. We have to add it now as per the accounts, and we'll do this comparison. If it is well within the limits, we'll leave it. If it is not well within the limits, we will bring it down. Accounts will ensure that. Don't. Okay. As of now, you don't have it. That's all. See, then I will understand. We'll take some examples as to capital and revenue. Okay. Let's come to this page number. Can you come to the question bank first part and tell me the page number? So all of you have revised how many times have you revised accounts? Not even once. 150. So there are many things here. Some of it we'll see as an example. First, overall expenses of second-hand machinery purchased. What is overall?
Including the making the
machines
already.
It is kind of like that only. It is making the asset ready to use. That means, see, when you buy a second-hand machinery, will it be 100% perfect? No. You should also get it repaired. And overhauling means you'll buy a second-hand machinery, you'll give it to this guy. This guy will do an overall check. Overall check he'll do, and he'll do whatever all repairs is required. This is called overhauling of the machine. And what all problems that machine had, now this guy will repair it. It's called overhauling of the machinery. So you bought a second-hand machinery and you have invested on overhauling. Tell me, is it capex or revenue? Why? Yeah, they are telling overall expenses of second-hand machinery purchased. That means, don't you think it will come in the last thing that we read? All the expenses which are necessary to make it ready to use. Correct? So it's a capital expenditure. Next, money spent to reduce working expenses. Working expense, and what you can understand is normal expense, operating expense, normal. Rent or something. You have invested some money on some technology. Example is, you have invested money on some technology of electricity, because of which your electricity expenses dropped. It was 10,000 every month. Because of this technology that you have installed, it became 2,000 rupees. 2,000. Solar. Okay. Now tell me. Capex. Why? Why revenue?
It
provides, it enhances and it gives the.
Okay. One thing.
benefit in the future.
See, the more good answer is his, because we are getting benefit from this solar for more than 12 months. Correct? Not only for less than 12 months. So it becomes capital expenditure. And you should also ask a question. See, here they have given only this much money spent to reduce working expense. The question you have to ask is the benefit is for less than 12 months or more than 12 months? If it is for more than 12 months, it becomes capital expenditure. If it is for less than 12 months, revenue. So if question sometimes if they are not giving sufficient info, write both. Tell them if the benefit received from this is less than 12 months, it is revenue expenditure. If it is more, it is capital expenditure. Right? Assuming it is more than 12 months, I am classifying it to be capital expenditure. Okay. Next, legal fees to acquire property.
Capital expenditure.
Why?
So legal fee will only give once, so we're acquiring.
So it is. How that? You are only telling one time, and you are only telling it in revenue.
Okay.
Correct. No. Guys, it comes to which classification? All the assets which is very important to purchase the asset. All the expenses that you have paid to acquire the asset is a capital expenditure. Now, whenever you are buying a property, simply you cannot just buy it. You paid the money. Say suppose you are buying a property which is building, land or building. What will you give the money and you'll come back? Then what will you do? How is the ownership transferred? Registration. How will who will do registration and all? Who will help you? Who will draft the documents and all? Legal base. For them, you have paid money. Now, this money is very important for me to use the asset. So, is it directly attributable expense? Yes, it is capital expenditure. Next, amount spent as lawyer's fee to defend a suit ಅಂದ್ರೆ case. Claiming that the firm's factory site belonged to the plaintiff's land. So they are telling some guy came and he's like, this is my job. And they put a case. Now tell me, is it capex revenue? Why not capex?
It is not directly related.
We are not acquiring anything. We have already acquired. It's not directly attributable. Correct? No? So generally you are operating. Some guy suddenly has put a case. Now we have to defend it. So efficiency not increasing or nothing. So it's a normal expenditure that you are paying to defend the case. Is it directly attributable? No. Some guys simply put the case. It's not directly attributable. So it's a revenue expenditure. Next, amount spent for replacement of worn out part of machine. Why not capital expenditure?
It's not increasing any efficiency.
That question you have to ask. If this replacement leads to increase in efficiency, then capex. So then here they have told it is worn out. When a part of the machine worn out, what will we do? For maintenance, we will change it. Do you think it will increase the efficiency? No. So therefore, see what happens even when you leave your vehicles for service. Sometimes some of them part will destroy. They will replace it. What your efficiency is increasing. Mileage became from 50 to 60 hours. So it is just maintenance. They have just replaced the worn out part. So it's a revenue expenditure. Expense incurred on the repairs and whitewashing for the first time on purchase of an old building. Why? Because directly attributable. So it's a capital expenditure. Next. So expenses in connection with obtaining a license for running the cinema were 20,000. The cinema company was fined 1,000 rupees for contravening the rules. Renewal fees 2,000 for the next year also paid. So three amounts are there. What to do?
20,000 is capex and 1,000 and 2,000 is revenue.
So what he told was correct. 20,000 is a license fee because to run the business you should have a license, and the benefit you are getting is more than 12 months. Correct? Because they are allowing you to run over many years. So license is a capital expenditure. Fine is something penal in nature, other than efficiency increasing or directly attributable. No, it's not. It's a penalizing action of the government. So it is a normal expenditure, revenue. Then renewal. What is renewal? To keep the license active, every year you have to pay renewal. Since you are paying renewal every year, you are getting benefits from renewal for how many period? For what period? For only 1 year or less than 1 year? No, because you are paying renewal every year. So since the benefit is 12 months or less than 12 months, it is revenue expenditure. These two revenue, this one is capital. Amount spent for construction of temporary huts, which were necessary for construction of cinema house, were demolished when the house was ready. Why capital?
It is related to
It is related to the construction of the cinema house, correct? No, without building, directly attributable. If without construction, I would have not invested for temporary huts. And if temporary huts necessary, yes. If you only build temporary huts, people can stay, they can build, then we can start the cinema house. Correct? No, it is directly attributable, so it is capital. 1,000 rupees paid for removal of inventory to a new site. Yeah. It's a revenue. Something was there, you have shifted it to another place, you have paid some money. It is normal expense. Revenue. Rings and pistons of engine were charged at a cost of 5,000 to get fuel efficiency. Since your efficiency is getting better, it's capital. So rest all is still fine. Wait. This one. Let's come to this one. Oh, this one you are telling. We'll do this. Money paid to MTNL 8,000 for installing telephone. Capex. Simple. Then come to this 14th. Amount spent on making few more exits in a mall to comply with government order. Have you understood the line? Now the government is telling in the mall, emergency exits will be there or normal exits will be there. Now government is telling create few more exits for safety. Okay. Revenue. Why not capex? Construction and all is happening. It is not increasing just because by creating more exits. Do you think my profits will increase or will my capacity to earn profits? No. Just because if I create 4 more exits, my capacity will increase. No way. So it's a revenue. No way where there is any efficiency. Repaint of existing building. You had one building and you are getting it repainted. So why? Because no increase of efficiency. Correct? No. There's no increase in efficiency. It's a installation of new central heating system. It's a capex. Then what? Cost of testing, whether the equipment is functioning properly. Before using the equipment, you are doing some testing. So is it capex? Why? It is necessary for using the asset, directly attributable. For me to use the asset, it is important for me to test it. Without testing, can I use it? No, it's directly attributable.
That's why they are not mentioning it's
Good one. They are not mentioning it. See, if it is not for a new equipment, then it becomes maintenance, revenue expenditure. If it is for a new equipment, it becomes. So you write down both because they are not clear about it. Cost of testing whether the equipment is functioning properly. If it is new equipment, it is capital expenditure. But if it's an existing equipment,
Can't we say if the equipment wasn't there, the cost wasn't be.
no. But sometimes what happens for maintenance, they will test it. ಆಯ್ತಾ ಕರೆಕ್ಟ್ ಆಗ್ತಿದೆ ಅಲ್ವಾ ಅಂತ. ಬಟ್ ಯು ನೋ ವಾಟ್, actually now that I'm thinking about it, it's better if we assume it to be new equipment. Okay, now why do you test it? Because you'll already be using it. If at all, if it is not working, you'll however come to know. No need to test it. See, when it is already you're using it, why will you test it? Don't you think? So it is for new equipment. Guys, it is for purchase of new equipment. Okay, so it is a capital expense. Okay. But somewhere in the question, if tomorrow they say it was cost of testing for existing, then consider it to be revenue. Okay, if they voluntarily tell it. If the question is silent like this, assume it to be new equipment. Okay. Next. See, like how we have capital expense, revenue expense, we also have capital receipt and revenue receipt. Okay, what will happen to capital receipt? It will go to balance sheet. Revenue receipt will go to profit and loss. Example of capital receipt: loan. Loan is a good example because you have to repay it. Can it come to income? No, it's a balance sheet item. Sale of furniture. What do you think? You have sold the furniture, the carrying value of the furniture was 8 lakhs. You have sold it for, say, 9 lakh rupees. To the extent of 8 lakhs, it is capital receipt. Because do you think it will come to P&L? No, we'll adjust it in balance sheet only, in machinery account only. So, sale of furniture till the extent of carrying value, it is capital receipt, and excess money over and above capital receipt will be considered as revenue because we record it as income. Here. To the extent of carrying value, whenever you sell the furniture or any asset, it is a capital receipt. Clear?
There is a loss in sale of furniture.
That will also go to P&L. Correct? If there is loss, say suppose the carrying value was 8 lakhs and you have sold it for 5. Then up till 5, it is a capital receipt. Then 3 will be considered as a revenue expenditure, as a loss, revenue loss. It will go to P&L. Then, example for revenue receipt, sales. Correct? Sales, commission, interest, all these are things which will go to your P&L account. So, how to bifurcate this when they ask? See, if there is a receipt and this receipt you are receiving in ordinary course of business, then it is a revenue receipt. What is ordinary course of business? Now, if I am a dealer of furniture, what is my ordinary course of business? Selling and buying furniture. Correct? So if I am getting money via that activity, it becomes revenue. If I am getting money from any other activity other than ordinary or normal course of business, then it becomes capital receipt. Simple criteria. In the
Line of business.
in the line of, yeah, whatever I am doing as a normal business within the business, then that is revenue. Okay. Now let's see some of the examples for this. What you have to do is, because of the limitation of time, I am taking only few questions. Now, after going to home, what you have to do? Do all the questions. And when you have any doubts, we can discuss it tomorrow. Correct? That is how we have to make use of this session. Next, insurance claim received on account of machinery damaged by fire. Is it capital receipt or revenue receipt? Is it your business to, destroy the machinery and receive money from the insurance? So it's a capital receipt. Then, amount received from IDBI as a loan. So loan, I told you. Can loan be your income? Only income natured things can go to P&L account. Is loan an income?
No.
No. Is it your ordinary course of business? Is it your business to lend loan and make money?
No.
So it's a capital. Then what do we have? Premium amount of rupees 1 lakh received on issue of shares. Remember, in your company account, you receive securities premium. You'll put it in that securities premium account reserve. What is that? Is that a revenue receipt or capital receipt? Capital. Because is it your business only to issue shares and make money? No. So it is a capital receipt. Then this one we read. Okay, this is like this with respect to expense. Messrs ABC and Co run a restaurant. Okay, they renovate some of the old cabins. Because of this renovation, some space was made free and number of cabins became 10 to 30. Total expenditure 20,000. Well,
Increase in the capacity.
increase in the capacity of earning. So it's a capex. So this one. Can you try this question and let me know the answers?
Which one is
29. Here, this one.
X.
That is 29. All Damara, Roman numerals and all.
So 30,000.
Others,
50,000 revenue of
amount. What is the question? Amount to be expensed.
25,000.
So that is 30,000 to be
revenue.
expensed. And then it's a revenue expense. So what do you understand by expense? And then which will go to P&L. Which expense means which goes to P&L. That is what you have to understand. So out of all the expenditures that they have given, only 25 plus 5 will go to P&L. That's why 30,000. Why? Because repair cost
For the
existing. Whitewash, because of whitewash, no increase in efficiency. So 25 plus 5 revenue. Cost of extension increase. Cost of improvement, the fact that they have told improvement, that means there is increase in efficiency. So 19 and 250 is capex. Another two are revenues. Clear? Done, guys. Amount received from trade receivables during the year. Trade receivables and the debtors. So I've received, you had made credit sales for 5 lakhs and they have given you the money later. Revenue, why?
Because it would be usually within 12 months. So
When did I say 12 months for receipt?
receivables generally will be within.
Hey, but where was this criteria for receipt? All this criteria was for expenditure. Trade receivable is what? Receipt. They're receiving money from
It is
debtors.
in the general course of the business.
No, there is nothing. See, there is nothing to think about the rules also. If you know accounts properly, you'll answer the question. Whenever you make sales, what is the journal entry? Credit sales. Sales, correct? Then, this is the entry. Here, did you book income? Yes, income is booked. Later, when you receive money from debtors, what will be the entry? So if you see, this item is balance sheet item. This is P&L item. So since P&L is coming, this is a revenue receipt. Here if you see when you are receiving money, bank is also balance sheet item. Debtor is also balance sheet. Is anything coming to P&L? No. Why? Guys, when the sales was made, at that time only revenue is recognized. Later when you are receiving the money from debtors, will you again recognize income? Will you again send it to P&L? No, it is a balance sheet adjustment. That's why it is a capital receipt. Because it is getting adjusted in balance sheet. Revenue is already recognized when you actually made the sales.
So you add it to trade receivables. The balance sheet.
Subtract it. Because we received money. We subtract directly whenever we receive money. The balance in trade receivables reduces. Is something happening to P&L? When you receive the money, see what were the wordings that used? Amount received from trade receivables. At the time of receipt, nothing will touch P&L because during sales only it has touched the P&L. Understanding? This is one of the peculiar. You should know it. When you receive money from trade receivables, again you cannot book income. It's already booked when you made the sales. Because you should understand, if you classify it as revenue, it is going to P&L. You should not forget that. If something goes to P&L, that means you are again recognizing it as income. Correct? So yeah guys, that's about your revenue. Rest all, please go home, solve. Okay. and come back with lots and lots of doubts. Let's discuss. Now, what about break? Do you think we have to take a break? Huh? We'll take a. Okay. Let's take a break for 10 minutes. Enough. Let's take a break for 10 minutes and we'll continue. Continue. Okay. We have to close the door. I think someone. Close the door. So let's continue. Okay. So till now, everything is there. Understood? Any problem? No. Now let's continue. Now let's understand the other accounting concepts and principles which is required. What do you understand by these concepts and principles? We have already read by now. So what do you understand? See, whenever we are doing accounts, as an accountant, while doing accounts, there are certain concepts or assumptions which you should have. While preparing the accounts, okay, there are certain concepts that you should follow for preparing of the accounts. Okay, now let's understand what are these different concepts that we as an accountant should follow. Most of it you'll be knowing. We'll start. First of all, first assumption that you should have as an accountant is going concern. What is going concern?
The business will be
Your assumption should be the business will be there forever. You don't know when it will end. It will exist forever. That should be your existence. That should be your assumption. Now you should ask me one question, sir. How is this assumption relevant for an accountant? On hing assume correct now. Why you should assume going concern? Because the valuation of assets depends on that. As I already told when I was explaining him. Say suppose there is one asset, okay, one plant and machinery. I have valued this plant and machinery to be 12 lakhs. Okay. On the asset in the balance sheet. In the balance sheet, in the asset, I valued it at 12 lakh. How will I recover the benefits, the economic benefits from that asset? By using that machinery for 10 years. If I use it for 10 years, then I will produce so many units, then that I will sell, then I will make money. This is how I'm expecting to get economic benefits from that particular asset. Okay. Again, I'm repeating, I have to use the asset for 10 years. I have to produce units. Then only I can make that much money, and I would have showed that much money only on the balance sheet also. If I'm showing the valuation at 12 lakhs, what am I telling? If I'm showing valuation as 12 lakhs, what am I telling? I am expecting to generate 12 lakh rupees worth benefit via using the machine, producing units, and by selling them. Correct? Now, say suppose today, something hits or something happens to the company and company is not able to continue. Tell me, is it correct for me to use that 12 lakh rupees valuation only? Why? Because if today something happens to the company should get closed. If the company should get closed or liquidated, then today only I should sell the machinery. Today, if I sell that machinery, how much will I get in the market? Only 5 lakhs. Now tell me, if going concern assumption is there, then I should show my valuation at 12 lakh. Okay, because I will use it, I'll generate money. If I don't have going concern assumption, then is it correct to show the valuation at 12 lakh rupees? No. Then 12 lakh will be more because the only way I can recover the money is by selling it. Then the valuation should be 5 lakh. So at what price should I value? Depends on the assumption. Clear? All of you? That's why going concern assumption should be there. Generally, if nothing is told, you'll assume the business will exist forever. Next, consistency. What is consistency? See, while preparing accounts, you'll apply many methods, many principles, many rules for preparing accounts. Okay. And one of the essential features of financial statements and accounts was what? Comparability. You'll compare it with what? One, previous periods. One more, other companies. Now, when you're comparing it with previous years, tell me, this year you have prepared accounts by using certain rules. Right? And previous year you have prepared accounts by using different rules. If you have used two different rules, do you think you can compare those financials?
No.
No. Only when you have used the same rules every year, then it is comparable. Right? In 1 year, you have used one rule of valuation. Say, suppose you have used LIFO. No, inventory valuation. In the second year, you have used FIFO. Third year, you have used WAM. Is it correct to compare? No. So what they are telling in consistency is whenever you are applying these accounting principles for preparing, make sure it is consistent every year. That means same every year. Don't change it. Sir, we cannot change it only. Yeah, we can. In certain exceptional circumstances, we can. Which are those exceptional circumstances? If law or statute requires change. Andre, if the law says, hey, from LIFO you change it to WA, I am telling you. If law says, change it. Or if you think by changing it leads to a better presentation, then you can change it. Andre, if you think, see, FIFO is not a better presentation, LIFO, WM is a better presentation for my business, then change it. So what is happening in LIFO assumption? You are telling last 10 items are going first. Correct. Is it a correct assumption? What will happen in general business? First in, first out will happen now. Because guy, if he brings something, first he try to sell the older ones, then he will sell the newer ones. Who will do this? Who is selling the newer items first? No one will do. So which is the better assumption for your business? FIFO. Now, if you are following LIFO and if you think FIFO will give you a better presentation, then you can change it. Okay. Generally be consistent. Only under two exceptions you can change it. Which are two? Required by law or leads to a better presentation. You can change it. Third one, accrual. This is Mahabab of your accounting. Okay. Everything depends on this one word in your accounts. Okay. What is accrual? What do you understand? Accrual means, okay. Now, we are recording this profit or loss for what period? For 1 year. In this 12 months, we are taking 12 months. So what you have to see is whenever you are recording an income or whenever you are recording an expense, what you should keep in mind is, have I actually earned the income? Have I actually incurred the expense? Is the question that you have to ask. That means, when have you actually earned? Now say suppose I am a dealer of furniture. The moment I sell furniture, the moment I give it to him, I have sold. I have transferred the ownership to him. I have transferred the risk and reward to him. Have I received the money? No. Even though I have not received the money, I have transferred the ownership. That means I have done my part. My income is accrued. I have to record it for that period. I should not care about the cash flow. Even if I'm receiving the cash towards this after 10 years, you shouldn't care. When is the income earned? The moment I transferred. I think you should focus on this. Similarly, expense. Now say suppose rent. You have not paid anything towards the landlord, but you have used his premises for 12 months. Have you incurred the expense? Yes. Why? Because you were staying there, you used it. That means you are supposed to pay. Will you wait for the cash flow? No. Cash flow will happen after 10 years also, you don't care. You should see when you used it and when you earned it. That is accrual. If you have earned it, record it. Don't care about cash flow. If you have utilized something, book the expense. Don't care for the cash outflow or cash inflow. Understanding? That is accrual basis of income. Any doubts, guys? Now, sale, credit sale. We will book the income. Why? Even though if you have not received the cash, we'll book. Why? Because of accrual basis. Because that belongs to that period. Now, better example to take. Say, suppose you have a loan. You have taken a loan. You took loan on 1st January. And you have not paid the interest. Till December, you did not pay the interest. Now, do you think I should not book the interest expense? Should I book or should I not book? As per accrual. Did I use the money? Did I incur the expense? Yes. I don't care about the cash flow. I should book the expense. Sir, but cash is only not going. What will you credit? For example, what is the entry for interest payment? It is generally interest expense increasing debit. Interest account debit to bank. Correct. But here we are not paying only. How can I credit bank?
Outstanding.
If you are not crediting bank, then what is happening? Your liability is increasing because you have already used the service. So instead of bank, what will come? Liability, outstanding expenses account. So understanding, don't wait for cash. Similarly, you have invested some money somewhere. Okay, interest you have not received, but you have invested from January till December, but you have not received the interest. What do you do? Will you book the income or will you not book the income? You will book. You don't care about cash flows. If you are caring about cash flow, it becomes cash basis of accounting. If you are not caring about cash flow, it becomes accrual basis of accounting. That's all, man. That is all in accrual. Clear? Next, we have other concepts. First one, money measurement concept. This you already know. What is it? Anything which can be measured in money only can come to books. Something which cannot be measured in money cannot come. Simple. Next, Entity concept. What is entity? Separate entity concept. Owner and the entity is separate for the purpose of accounting. Correct? Can you give me one example in accounts which shows this concept? Anything? The fact that capital comes in liability side are drawings. Correct. The fact that capital comes in liability side is because entity concept. See, if I have my own business, then my capital business everything is same. Why am I showing my own money as a liability in capital side? Because
That is liability to the
business, correct? Because business is telling, hey, you had invested 5 lakh rupees, now I have to give it back later, correct? So that's why we're adding it back. And also, as she said, drawings. Same thing, my money only I'm withdrawing. Why should I show it in the books of accounts? Because we are two different people. That's why we are showing drawings also, correct? Again, whenever now I am a owner, I have invested money. The money is earned by the business. Later, ultimately, when you do your final account, there is profit in P&L account. Where will you put this profit later? You'll add it to the capital. Why? Because the profit belongs to owner. So you'll add it to the capital, saying that along with capital, I'll give you profits also. Correct? So this is because of entity concept. Here, next. Materiality. This we have already discussed. What is material? Something which influences the decisions of the user. If it is a material information, disclose it in the financial statements. Should it always be monetary only? So if something to be material, should it be monetary? No need. In the example that I gave you, was it monetary? No, that was just a matter about director. He had not even done the cheating. The fact that he is doing cheating is also enough. So, whenever you're judging something to be material, that need not be monetary. If you think that information influences the decision, it is a materiality thing. You have to disclose it in the financial statements. Then periodicity. Now, what is periodicity? Now, just because we are following going concern assumption, what will you do as an accountant? If someone asks you, your owner will come and ask, hey, give me financial statements. Sir, I'm not prepared only. You're not prepared. Why? Sir, because going concern assumption. Why going concern assumption? Sir, the business is not ending only. I'm waiting for it to end there. So once it ends, I will prepare my financial statements. Will you do that? No. Even though the assumption is going concern, we will prepare financial statements for specific periods. In our example, that is 1 year, 1 year, 1 year, 1 year. For every 1 year. For some listed entities, it's also prepared for every 6 months. 3 months, quarterly. Correct? Or if the management wants it for 6 months, we'll prepare it for 6 months also. Correct? What are we doing here? We divide the entire life into periods. Generally, for our example, it is 12 months. And we do it for 12 months. We record all the income and expenses for 12 months and we'll present it in P&L. Correct? It is divided into periods, the performance. Correct? No? That is your periodicity. Next, matching. What is matching concept? Very important.
Debit side and credit side.
And in your P&L, the credit side is your.
only or expense should be.
See, what is expense? Expense leads to some economic benefits, some kind of benefits. We discussed now. When you expend something, it will lead to some economic benefit, either less than 12 months or more than 12 months. Now, what they are telling in matching concept is this both should match. If you get an economic benefit from something, that will come in your income side. And whatever you have spent to get that economic benefit, that should come in expense side. Both should match. It should not happen in such a way that the economic benefit is coming in the next year and the expense that you have made because of the economic benefit is coming in this year. Not possible. Both should match. It should come in same P&L. The economic benefits and their expenses should match. Okay. Now, just to take a better example for this is, say suppose one of you, any example, you have, say suppose you have 10 mobile phones. You have purchased 10 mobile phones for 1,000 rupees each. Okay. How much? 10 mobile phones. So your total purchases is 10,000. And out of this, you have sold 5 mobile phones for 2,000 rupees. So your sales is
10,000.
Shabash. Now, how much is your profit? Sales minus purchase is equal to 0. So your profit is 0. Hey, 0 no? Sales minus purchase.
5,000.
Quantity should be matched.
Correct. No, what you are doing here, sir, here we are selling 5 mobile phones, but you are comparing it with the cost of 10 mobile phones. Cheating. That is cheating. So what you have to do? You have to match it. If you are selling 5 mobile phones, the cost should also be matched with 5 mobile phones. So if you match it with 5 mobile phones, what will happen? 1,000. So cost is 5. This is called cost of goods sold. Correct, na? So profit is 5. No, it is correct. Correct. So this is called matching. If you put 20 and 10, is it matching? No. Why? Because economic benefits is towards only 5 mobile phones, but you have put expenses of 10 mobile phones. Is it matching? Not matching. To match it, what will I do? I will consider only the cost of 5 mobile phones. Is this being actually done in our final accounts also? So when you prepare trading account, let's prepare the same thing, same scenario. Here purchases 10, sales is 10, right? Gross profit is still 0.
Opening stock.
So to ensure this matching, what will we do? We'll put a closing stock here. That's why that is the only asset which comes to P&L account. Why? To do the matching concept. So how much is closing stock? 5. You'll value inventory at cost. So 1,000 into 5, 5,000. So how much is your profit now?
5,000.
No, it is correct. That is so even in your final accounts, this concept is getting ensured via this closing stock. Understanding? Done. So that is your matching concept. Your income and your expenses should match. So next, dual concept. So what is dual concept? So we are following a double entry system of accounting. Correct? No. So whenever we are recording the transactions, we are recording it via journal entry. Now, if you see journal entry, the format is, say if it is sales, bank account debit to sales. There is a debit, there is a credit. For every transaction, you have to find out 2 aspects. And you have to give effect to 2 aspects. That is how it is there. That is how we do accounting. This accounting is called double entry system or dual aspect. Why? Because every transaction there is dual aspect. You give me any transaction if you want. Let's check. Rent paid. What are the 2 aspects? Rent is an expense which will go to P&L. Since they have told paid, your cash is decreasing. So 2 aspects. Then anything you take. Salary paid. Salary and cash. Correct. The sales happened. Debtors to sales. Debtors, whenever you make credit sales, your debtors is increasing, and your sales, which is an income, which is increasing. So if you see, for every transaction you have 2 aspects. So that is your dual aspect concept. Then we have cost concept. So historic. So what is cost concept? Cost concept means, let's say suppose I started a business. I invested the capital and I've bought a new land here in Jayanagar. Okay, when I bought it was many years. When I bought it was only 1 lakh. Today it is crores. But do you think I will show it at the revised price in our books of accounts? No, I'll maintain it at cost only, 1 lakh only. Today the value is 9 lakh, but I'm maintaining these assets at cost. No matter what is the current value. This is called what? Historical cost concept. Irrespective of today's market value or whatever it is, you are still keeping the asset value at cost only. It's called historical cost method. Other concept. Okay. So that means we'll not bring it only, we'll bring it. That is called current cost concept. So what is current cost concept? Here, as per current cost concept, you are valuing that asset at the current cost. All of you? Current cost. That means what was the current cost of the building? 1 crore. If you are showing this asset at 1 crore in your balance sheet, then you are following which method? Current cost concept. If you are showing it at old cost only, it's called historical cost concept. Clear? Then you have present value cost concept. Present value andre no. Now you understood current cost, historical cost. There is one more called as realizable cost. Not realizable method. That is different. That is a different realization concept is a different concept. There is realizable cost. Now what is realizable cost? So we'll take an example and we'll understand what each of it is. Okay. Now what is the vehicle I have? I have a Suzuki Access 125. Okay. Now take this as an example. I bought it 5 years ago. 5 years ago I bought it. Okay. When I bought it 5 years ago, it was 70,000 rupees. Okay. 70,000. Today, the value of a brand new Access 125 is how much? 1 lakh? 1.25 lakh. So 1.25 lakhs is the cost of the brand new Access 125. So this is current cost. What is historical cost? 70,000. Okay. Then there's something called as realizable value. What is realizable value? Not cost, is realizable value. So what is realizable value? Realizable value under the cost of a 5-year-old Access 125 today after depreciation. So today, if I want to buy a second-hand 5-year-old Suzuki Access 125, how much it will be? Say suppose some 50k, which is more only 50k. Okay, so that becomes realizable cost. You're understanding what is the difference between current cost and realizable value? Current cost is the cost of the same Access 125 brand new today. Realizable value is the value I'm getting for a 5-year-old Suzuki Access 125 today. That is realizable value. Current cost is the brand new. Understanding? Historical cost is the cost that I paid. Very clear? 100%. Then we have present value. What is present value cost? Now I told you, if I invest in any plant and machinery, say suppose that plant and machinery is 5 lakh rupees. And how is that 5 lakh shown in my balance sheet? It is the economic benefits that I'm receiving over the value of the machinery. Say suppose this machinery which I buy can be used for 10 years. Then I'm estimating. First year I get economic benefit of 50k in the first year. Second year, 50k. Third year, 50k. Like this. For 10 years I will get benefits. So what is the value? 50k into 10. How much is the benefit that I'm getting? 50k into 10 is 5 lakh. So 5 lakh. What we are doing is, but am I getting 5 lakh today only? No, I'm getting 5 lakh over the 10 years. So don't you think present value should come in here? So what was present value? The value of today's money and the value of tomorrow's money is two different things. Understanding that? You understood present value now? See guys, I'll ask you a question. Tell me which one will you select. I'll either give you 50,000 rupees today or I'll give you 50,000 rupees after 1 year. Which option will you choose? Today. Why? Because, say suppose you're supposed to give me 50,000 because I've given you something, loan or I've sold you goods, whatever it is. And I'm giving you two options. Either give it today, 50,000 or give 50,000 after 1 year. Which one will you choose or which one will I choose? Because I'm the one who's receiving the money. Which one will I choose? Today. Why? Because if I get 50,000 today, I can keep it in bank and after 1 year it will become 60,000. But if I opt for the second one, what is happening? I'm not even getting today 50,000. I'm getting it directly after 1 year. So will I get this interest benefit which I would have got? No. So which one will I obviously choose? The first one, where I'll get 50k today. This difference is there. No, this is called present value of money. So can I easily say the value of money that I get today is better than the value I get tomorrow? If I take some similar amount of money, which is better? The value I'm getting today. Because today if I have, I can invest it somewhere. If I get it at a later stage, I'm losing out on interest. This is called present value of money. That's all. Now here you're getting 50k over 10 years. Correct. Now tell me, if receiving 50k per year over receiving 5 lakh rupees over 10 years, is it same as receiving 5 lakh rupees today? No. If I get 5 lakh rupees today, imagine for 10 years how much money I'll have. But I'm getting 5 lakh over. So I'm losing a lot of interest. So do you think the 5 lakh, the present value of 5 lakh is a little lesser? Because if I had gotten it today, my future value would have become much more. I'll earn so much interest. But I'm not getting 5 lakh today. I'm getting 5 lakh over many years, because of which I'm losing a lot of interest. So my present value will be less. So the 50k, if I bring it to present value, now how to bring it to present value, all that you know in maths. That is not my jurisdiction. Okay, that you already know. The rate of interest you'll use now to bring it to present value. That is the perceived rate of interest that you're losing. You know, you'll use one rate of interest for bringing it to present value. What was the formula? Is equal to 1 by 1 into r to the whole power n. The r is the rate of interest which you lose. Understanding? That much I can say. Okay. ನಮ್ಗೆ ಅಕೌಂಟ್ಸ್ಗೆ ಟೈಮ್ ಇಲ್ಲ ಇಲ್ಲಿ ಇನ್ನು ನಾವು ಮ್ಯಾಥ್ಸ್ ಎಲ್ಲ ತರಕಾಗುತ್ತಾ so the present value of 5 lakh, will it be 5 lakh? No way, it will be much lesser than 5 lakh. Say suppose it is 4 lakhs. I will value the asset at 4 lakhs. This is called present value cost. Andre you will take the cash flows that you will receive from this asset over the life of the asset, bring it to present value. At that value you are showing the value of the asset in the balance sheet. This is called present value cost concept. So all the four you understood. Historical is old. Current is the value of that new machinery today. It's the current. Realizable, the value of this same machinery. If I sell today, how much I will get? It's this machinery only, which is 5 years old. If I sell it today, what is the value? That is realizable. Present value is you are present valuing all the cash flows that you are getting from this asset, and you are valuing it at that amount. Understood? That is about all the concepts. Now let's enter into financial statements. So what does financial statements comprise of? It consists of balance sheet. It consists of P&L. Then it consists of it comes under P&L. It consists of cash flow statements. It consists of notes to accounts. What is cash flow statement? It is right now out of syllabus, but it consists of your cash inflow and outflow of the business. Why? Because we prepare accrual based of accounting where we ignore cash flow. Correct? So it is very important for us to know the cash movement because we are preparing accounts on accrual basis. Correct? So that's why they give you cash flow statement. Right now it is not your headache. Then you have SOC, statement of changes in equity. Okay, that is also right now not your headache. SOC means reserves, capital is there in balance sheet. The movement between this capital and reserves will be given in SOC. How it is increasing, how it is decreasing, why it is decreasing. It will be given in SOC, called as statement of changes in equity. So 5 things comes under your financial statements: balance sheet, P&L, notes to accounts, cash flow statement, and SOC. Clear? Now in that you already know what is balance sheet, what is P&L. Only 2 things we are focused on. 3 things: balance sheet, P&L, and notes to accounts. Others, however, we are not preparing. You should just know for safety reasons if they ask theory. Okay. What will P&L do? P&L will show the profit or loss made by the company. Balance sheet will show the financial position of the company. Andre assets and liabilities as on the given date. So that's why whenever you are preparing balance sheet, what is the wording you use? Balance sheet as on. Andre you are giving the position of assets as on that date. That date. But in P&L, you are giving income and expenditure or profit or loss for a period. Andre for 1 year. In 1 year, how much profit I made? So that's why we say P&L account for the year ended, because it is for a period. Where balance sheet is not for a period, it is as on 1 day. As on 31st March, how much assets do I have? How much liabilities do I have? It is giving position as on 1 day. Okay. So P&L gives the profit or losses made. Financial position will give the asset or expenses asset or liabilities that a business holds as on a given date. Cash flow will give you cash inflow, outflow. Notes to account. What will notes to account give? It will give the additional information and explanation for the users of the financial statements to understand the accounting better. Extra information is given in notes to accounts. Okay. This and all is still fine. 3 things. Other characteristics which you should understand. What are the other characteristics? Various concepts that we learned. No, there are other characteristics of the financial statements, and these characteristics should be complied with whenever you are preparing a financial statement. First one is completeness. What is completeness? When you are recording all the transactions and whenever you are preparing financial statements, all the transactions should be there. All the transactions should be covered. Then only you prepare financial statements. Say suppose one security guard one day he had drank one Red Bull or something. He'll be like, sir, it is immaterial, let me leave it. Angala. No matter what it is, bring all the transactions to books of accounts. You should cover all. Then only it is called complete. So a financial statement should contain all the transactions. Second one, prudence. So I told you, I'll explain what is prudence. So whenever there is a financial statement, whenever you are preparing, an accountant should be prudent. What is prudent? Prudent ಅಂದ್ರೆ a normal guy. We were discussing something. You asked me something. Bribe. I said you cannot bribe a judge. He was like, why not, sir? It is possible. So I'm giving this example. Whenever you're thinking about an assumption, you should be prudent. Okay. What is prudent? Prudent means what would a wise man, what would a man with normal knowledge, wisdom, will do in a certain situation? That you should consider. Okay. Now, there is an income. You're an accountant. Company is earning an income. You are not sure that whether this income will be realized. You're not sure. It might come or it may not come. Will you record that income? Why will you not record?
Because
Conserve. That is what a prudent man would do. No? A man with normal wisdom, normal judgment. What will you do? Oh, this income is pakka na. It is not probable. I will not record it. So that is prudent. You should not do something else. To take a better example, let's say suppose this is Search Academy. Suddenly fire. Something happens, some short circuit or something happens, suddenly fire appears. What will you guys do? You try to extinguish the fire, or you will try to run away. You try to call fire engine. Correct? This is what a prudent man would do. Now, what if one of them will suddenly go there, starts Homa? You start with the mantra. That is not what a prudent man does. Prudent man will run. So while doing accounts also, you should be prudent. Correct? That means in your place, if there was another accountant, then even you should have done the same thing. Even if you are there, you should have also done the same thing. Now, whenever there is an income, if you think it is not probable, you should not record. If you are recording, this time our profits is less. Let me do one thing. I'll record it. I know it. It will not be realized, but let me record. Later I'll reverse, so that current year profit will be more. This is not what a prudent man does. So while doing accounting, please be prudent. And the new madadro, same result should be there. If another accountant also does, same result should be there. Different paper. Understood? That is prudence. So when taking assumption, what is a prudent assumption to take? Judges normally, judiciary, they'll not take bribe. Normally. At the very exceptional cases, they'll take. You should be prudent while assuming also.
So now not taking is exception.
Correct. Not taking is an exception. That's why don't do that assumption. Correct, sir? Hey, not taking is normal.
No, I'm talking about present world.
Hey, no. But see, police and all is still okay. But imagine judges taking bribes. Then imagine in what world we are.
No, so that's the thing.
Hey, but not all of them, man. Or else imagine, no, system would have collapsed. Imagine judges taking bribe. Imagine if Supreme Court judge, if he takes bribe, gone only. Elder shedel. See, I'm not talking about anyone. It's all coincidental. Resemblances are coincidental. We are not telling anything, okay? We are on camera. So imagine, disclaimer. So substance over form. So third thing, what do you understand by substance over form? So most of the times, if you have seen my regular class, I don't think anyone have attempted. If you have attended. So in my first class, I have a presentation, PPT as to why accounts is as good as cinema. Okay, there's a proper PPT presentation that I'll do, but right now we don't have time. So most of the time I'll tell accounts is as good as cinema. So this is one of the feature why I say it is cinema, because in cinema you'll be seeing many things. They'll say, hey, I will bring out your true colors. In Kannada, nija banna bayal martini. Correct? No? Most of it will be like that. I'll bring your true colors. Or there is one song, Satya Kandaru Pramanisi Nodbeku. Even if it is true, even if it is appearing to be true, whatever you are seeing is not true. Correct? Satya Kandaru Pramanisi Nodbeku. Correct? No? So this is exactly what this line says. Satya Kandaru Pramanisi Nodi. Andre, don't just see the transaction just by name. Okay, see the substance of the transaction. Then it might lead to some other judgment. For example, just to take an example, okay, take preference share capital. You understand what is preference share capital? So what will happen in preference share capital? Why are they called preference share?
First, they have to share the profit.
Because, see, I'll tell you, in preference share, every year you are giving fixed dividend. Correct? This fixed dividend is based on a percentage. Correct? All of you agree? Every year you are paying. Then preference share people have preference over the assets during liquidation. That means when company is dying and going away, what will company do? It should sell all the assets and give it to owners. While giving that, if the company has lesser assets to give, it will give first preference to preference. And first it will give to outside liabilities. Then it will give to preference shareholders. Then it will give to owners, equity shares. Correct. Preference shareholders are also getting preference over the realization of assets. Now, if you see this transaction, what we have done is all this way. Just because they have used the word capital, we are putting preference share capital in capital under balance sheet. But see the substance of the transaction. We are giving fixed percentage of dividend every year, as good as interest. And we are giving preference during liquidation, as good as outsiders liability. Then why are we calling it as capital? Correct or wrong? You are giving interest like liability. You are giving preference also. Then how come they are the owners? How can we call it capital? Equity shareholders are the real owners. These people simply we are calling them capital. So if you go to Ind AS level, no, we'll put preference share capital under liability because that is substance. Understanding? Here we are not just seeing the form. Nodak bereno irbodu, but it is a liability. It's a loan. So what am I doing here? I'm seeing the substance of the transaction rather than the form of the transaction. Form is different. In form, they are telling capital, but substance is something else. Correct? So that should be one more thing. Whenever you are doing an accounts, don't just do the form. See the substance and then do the accounting of the transaction. So that are the three more characteristics. Clear? So that is about your different concepts and this thing. So let's go. I think we are done. Okay, almost there. So next, come to accounting policies and accounting estimates. Now, what is this? What is accounting policy? What is accounting estimates? So, I'll tell you. Accounting estimates you already know. What is accounting estimates? In accounts, while preparing accounts, we use estimates in many places. Examples in depreciation we took, in PDD we took. Correct. All these are various estimates that you will use during the account, and it is an estimation. Is provision an estimate? Provision, you remember just now. What is provision? Huh? It's a present obligation which can be reliably estimated. That means it's a estimate only. Correct? No. Why confusion? It's an estimate. So all these are different estimates that we use in accounting. That we are clear. For example, if I have to tell in depreciation, your useful life, then your scrap value, all these are different accounting estimates. What is accounting policy? Now, accounting policies, while doing accounts, okay, you have different methods to do accounts. There's not only one way. If you observe, while doing inventory valuation, you have different methods: FIFO, LIFO, AA. Don't you think for doing the same inventory valuation, you have three methods: FIFO, LIFO, AA. So the different methods that are there to do the same accounting, these are called accounting policies. Okay. Now, what makes something an accounting policy is a question. The important feature of accounting policy is that you should have a choice. Now I told there are 2-3 methods. Between these 2-3 methods, if you have a choice, it is called accounting policy. Correct? Now take the example of inventory valuation. You have 3 methods: FIFO, LIFO, WM. Do you have a choice?
Yes.
You have a choice. No. If you want, you can use FIFO. If you want, you can use LIFO. If you want, you can use. You have a choice. Or if you remember your depreciation chapter, there is 2 models: cost model, revaluation model. Correct? Cost model means you keep the asset at cost only. Revaluation means you'll bring it at current cost. Correct? That is option. If you want, you can keep it at cost model. If you want, you can keep it at revaluation. Now, these are what? Accounting policies, because you have a choice. Clear? Cost or revaluation, whichever you want, you can use. Clear? SLM or WDV. Can you choose whichever you want? Okay. No ways. SLM or WDV is not accounting policy. It is change in accounting estimate. Sir, estimate. Sir, two different methods, no, sir. But what did I say? For something to be accounting policy, there should be choice. Between SLM and WDV, we don't have choice. Why? Because your accounting standards say that depreciation should reflect the pattern of economic benefits. Andre, they are telling, if it is an asset, it will give you economic benefit. Now the fact that depreciation exists is because of matching concept. Why? Because you are buying a machinery today and you're using it for 10 years. That means you're getting benefits over 10 years. Don't you think the expense also should spread over 10 years as per matching concept? But what will happen? You're purchasing in the first year only. If you put it to P&L, then entire expense will be booked in first year only. Then you are not following matching concept. That's why we bring depreciation. What will we do depreciation? We'll take the total cost, spread it over the useful life of the asset. Now it is matching. Okay. Now what the accounting standard says is this depreciation should reflect the pattern of economic benefit that you are receiving from the asset. Now, if you buy a machinery, do you think it will perform same every year?
No.
Then initially it will perform better. In the end, it will perform weak. The performance will be very less. Don't you think even the expenses should be more in the initial years? That means depreciation should be more in the initial years and less in the later years? Or should it be same every year? Or should it be more in the initial years and less in the later years?
More in constant.
It should be
Constant over years.
constant. But I told you the economic benefits is more in the initial years and less in the later years. Why? Because that's how, no? If you buy a new motor vehicle, it will be working well in the initial years. In the later years, it will be weaker. Correct? No? Don't you think even the depreciation should be like that only? More in the initial years and less in the later years. That's what accounting standard says. That should match. Now, the accounting standard has told it should match. Do I have an option between SLM and WDV? No, because SLM, what will happen? Every year, same depreciation. WDV, depreciation more in the initial years and lesser in the later years. So I don't have an option because accounting standards told that your economic benefits should reflect, your depreciation should reflect the pattern of economic benefits. So do I have an option? No. Therefore, SLM WDV is a estimate. There's no choice for it. So it doesn't become accounting policy choice. So that is your accounting policy. So different methods where you have choice is called accounting policy. Okay. So as per the one more assumption we learned, accounting principles or policies that we apply should be consistent. Accounting policy that you have selected also should be consistent every year. No? If this time if you have used FIFO, next time also you should use FIFO. Third year FIFO. So you cannot change it only. To which was that too? Same thing. See, same thing they have given here. You can change the accounting policy in two situations. When statute says or when it leads to better presentation. Same thing given here. Okay. Now you understood what is accounting estimate. You understood what is accounting policy. And under two circumstances you can change. Okay. Now what we have to understand is whenever there is change in accounting policy, how to do the accounting. Whenever there is change in accounting estimate, how to do the accounting. Now let's first come to change in accounting estimate. These problems you have, okay? You have these problems. Now estimate is an estimate. That means what? It's a guess. Guess is bound to get changed. Correct. Estimate and change agdane irutta. There are chances of change. Now, if it changes, do you think I have to do something crazy in accounts? No. You know it's an estimate. You know it will change. So what we'll do is whenever there is change in accounting estimate, we do prospective accounting. That means we don't care what has happened before. We'll only see future. That's why it's called prospective accounting. Prospective andre. Spec means eye. That's why we call spectacles eye. Spec means eye. Pro means front. Prospective, seeing front. Okay, correct. So since estimate is bound to change, we don't care what has happened before. We do prospective accounting. Now, example of prospective accounting, go back to your depreciation chapter. In depreciation, you used to have one question. I thought suddenly the useful life from 6 years became 10 years. Remember? So useful life is what? Accounting estimate. So from 6 it became 10, means it is change in accounting estimate. So how did you do the accounts? You just took the carrying value as on that day, divided by remaining useful life. Did you see what happened before? No. That day's carrying value divided by remaining useful life. You're doing prospective accounting because you're not seeing what happened before. You're seeing what is happening forward. So for change in accounting estimate, you're doing prospective accounting. For change in accounting policy, retrospective accounting. That means now you're looking back. Why are we looking back for accounting policy? Now, in accounting policy, you had choice. You should have selected properly. I thought. Now, whenever I give a choice, what will these accountants do? They'll use it for their benefit. See, sometimes FIFO will be useful. They'll use FIFO. Next year, when they use LIFO, profit will be more. They'll use FIFO. Next year, when they use WM, profit will be more. They'll use WM. All this nonsense they'll do. If I give you a choice. In estimate, we don't have choice. But in policy, we have choice. If I give choice, people will play with it. So what I'm telling, hey, if there is a change in accounting policy, no, you have to do a retrospective account. That means go back, rework the calculations as if the first day only you selected FIFO. Then right now you don't have all that. It will come at the final level. But you understand now what is retrospective. I'll not let you do prospective. Go back, do the workings as if you selected FIFO from the first day. So it's a tedious process. So for change in accounting policy, we do retrospective accounting, and for change in accounting estimate, we do prospective. Because estimates are bound to change. Why to see back? We'll do prospective. Okay. That is about your accounting estimates and policies. Then we'll come to accounting standards. What is accounting standards? Now, the thing is, what problem happened with accounts is there are various accounting policies, so various accounting principles to do accounting. Now there are India is so big. Okay, there's one business in north, east, west, south, 4 businesses. Now there is an investor who is coming from Africa to invest in our business. Okay, one guy has followed one method. North guy has followed FIFO. East guy has followed LIFO. What to do? And then imagine if they can follow, that is not a problem. See, one guy is following one accounting method. What to do? One guy is valuing inventory at cost. One guy is valuing inventory at net realizable value. How will investor compare? Because whenever you see comparability, one of the features of financial statements is comparability. You'll compare with previous periods, you'll compare with other entities' financials. Why? Because you're investing, you're comparing. When you're comparing, don't you think all of them should have followed same standards for accounting? Only when they follow same, it will be comparable. Because all of them have followed same rules for accounting. If one guy has followed one rule and the another guy has followed another rule for accounting, is it comparable? Not possible. So that's why what they did was they bought accounting standards. Now accounting standards is set of accounting rules. Whoever is following accounting standard, all of them are following same rules. Now is it comparable? Yes. Now what is accounting standard? It is set of rules that an accountant should follow for the purpose of their accounting. Issued by Institute of Chartered Accountants of India. Okay, they'll only frame it. Now it is framed and made by Accounting Standards Board of ICAS. There's the Accounting Standards Board. ISB. What is ISB? That is for international level. ASB, Accounting Standards Board, is for AS level. For India's IASB and all will come. Okay. You know what is India's global level accounting standards? Accounting standards is for Indian level. Who prepares it? ASB under ICAI. It will prepare it. And for companies, who will prescribe accounting standards? See, companies will come under Companies Act 2013. So can it follow ICAI's rules? No. So what will happen is companies' rules only will prescribe the same accounting standards. Companies Act will say, hey, follow accounting standards. So for companies who is prescribing accounting standards, Companies Act only. Because companies come under Companies Act. What about non-corporate bodies? All the entities which are other than companies, who will prescribe? ICAI will prescribe. Because they don't come under any specific law. So for them, accounting standard is prescribed by ICAI. For corporate entities like companies, for them accounting standard is prescribed by Companies Act or rules. Clear? Okay. Now accounting standard is for India level. India is for global level. Now in my example, what happened? One business is there in one direction, north, east, west, south. What if there is a business in Japan, there is a business in Africa, there is a business in America? I am an investor who wants to invest. Then I should ensure that all of them are following same standard. How to do? Within India, we have accounting standards. What to do at global level? There comes IFRS. IFRS is used in more than 110, 120 plus countries. So at global level, we have something called as IFRS. The Indian version of IFRS is called as Ind AS. Okay, Indian version of IFRS is called as Ind AS. So what is accounting standards? India level standards. And Ind AS is the global level standards. Okay. For you, AS is important. AS is issued by ICAI. For companies, it's prescribed by Companies Act. Okay. Now, if you see the next page, you have list of accounting standards. Okay. One more thing we have here. Okay. Now, if you see here, we have list of accounting standards. Is it important for you to note, remember all this? No, because you however read in your intern. But this is how your accounting standards look. For inventories, you have to go to AS2. For cash flow statement, AS3. For prior period and all, AS5. For PPE, AS10. For an exchange, AS11. Like that. For each and every transaction, there is a standard. You have to follow those accounting rules. This is how it is. For each and every type of transaction, there is. Where will your intangible assets come? In AS 26. It will come here. Sorry. In AS 26. Correct. In Ind AS, it is 38. Okay. So where your PP will come? AS 10. So everything. You have the guidance for each and every kind of transaction. Okay. Now tell me, for what companies Ind AS is applicable? For what companies AS is applicable? For companies which comes under Companies Act, normally AS is applicable. Ind AS is applicable for those companies whose net worth is more than 250 crores. Net worth is assets minus liabilities. So if it is more than 250 crores, Ind AS is applicable. Or if the company is listed, what do you understand by listed? If their shares are listed in the stock exchange, and then if you can trade their shares, the buy or purchase if you can do of the shares issued by the company, then it is called listed entity. For listed entity, Ind AS is applicable. Or if your net worth is more than 250 crores, Ind AS is applicable. AS is applicable for all the companies coming under Companies Act. Ind AS more than 250 crores net worth or listed companies. Clear? Done? Done, guys. We are done with the intro chapter. Now let's enter into the actual accounts. Now we'll come back to our definition. What is the definition? Now, for the remaining time, okay, I will give you the flow as to how our accounts will run. From the point where transaction happens till how it comes to balance sheet. Okay, I'll give you one run through. Okay, I want all of you to, with 100% concentration, you have to listen. Okay, what I'm telling now is how a transaction flows from the moment it happens till the balance sheet. I thought it's very interesting. If you understand this, you have understood the accounts only. This 15 or this 20-30 minutes discussion that we have. Okay. Okay. First, the transaction happens. Okay. Whenever transaction happens, what will we do? We will record it. Okay. How will we record it? We'll record it via. Then we'll post it in. Then after ledger we prepare. Then once trial balance is over, we'll prepare final accounts. In final accounts, what will come? Trading P&L account and balance sheet. Trading P&L, balance sheet will come. This is the flow of the accounts. Okay. Now let's see how this flow works by taking actual examples. Okay. Now I'll take first what will happen. First transactions should be there in the business. Okay. Now I'll take 5 transactions for example. First, proprietor invested 1 lakh rupees, 5 lakh rupees. 5 lakh rupees in the business. Okay. Then he made purchases of say 2 lakh. Next, he made sales of 3 lakh. Okay. Then purchased furniture of 1 lakh. Then anything you want me to do? Paid rent. No need to write down. Not write down. Just watch the discussion. Okay. No one. Please don't write it down. Paid rent of 50,000. Correct. Then what information we need? Then I will go down in the end of the year. I will count the stock, and I have closing stock of say I purchased 2 lakhs. I have closing stock of 1 lakh rupees. Okay, these are the information given. These are the different transactions, and I went to go down also. I've got 1 lakh rupees. So how will closing stock come to books of accounts? In trading account. So in trading account it will come in trading account and in balance sheet closing stock will come. How? You'll see this is how it will come. You'll directly go down. You'll count it. Whatever is there, that amount you'll come and put it in trading account as stock. Okay, that's why I've also taken the closing stock amount. Okay, we have to go. How will we know? I took one example: 10 mobile phones, 5 mobile phones. How did you know that 5 mobile phones is still there? You actually saw your pocket. There 5 mobile phones was there. Like that, here what we have to do? Go down and get the number. I've got it. How much we have? 1 lakh worth clothing stock we have. So this much information we have. First, in the flow, first thing happened. Transactions happened. Okay. Now I have to record them in the journal. For this, journal entry is required. Okay. Now journal entry. How will we do journal entry? For every journal entry, we'll have 2 aspects, correct? A debit and credit. We have 2 ways to formulate journal entries. Okay. One is your golden rules of accounting, and one more is your modern approach. Correct? I hate golden rules of accounting. It doesn't make any sense. Okay. So I will follow the modern approach. But for your purpose, it is better for us to know everything. Correct? So what is the golden rule? In golden rule, everything you will classify into 3 different accounts called as real account, personal account, and nominal account. Right? What is real account? All the assets or liabilities. It's a residual account. Right? Actually, first let's understand what is nominal. Nominal means all the accounts which represents income, expense, or loss or gains. These are nominal accounts. And the rule for nominal account is debit all expenses or losses and credit all incomes or losses. Then comes the real account and personal account. Personal account means any account which is other than nominal account, and you can represent the name of the account by the name of a person. Then it is a personal account. For example, debtor. Can you represent it by name? Yes. Rent payable.
No.
Rent payable. Why not? Say suppose your owner name is Nagraj. The liability towards rent payable can either be in rent payable account or can also be in Nagraj's account. Possible? Yes, it's a personal account. If you can replace the name of the account with person, it's a personal account. Anything. Salary payable, it's a personal account. Income tax payable,
No.
why not? It's not a person's name. See, what you have to understand is, whenever I say person, it is not only natural person. It includes artificial person. Okay. So is government an artificial person? Yes. Okay. Say suppose I've invested in one company. Equity shares. I've invested in the equity shares of a company. Personal account. Can I replace it with a name? I can replace it with company name. Company name is what? Company is an artificial person. I can replace it. ABC Limited. So it's a personal account. I've placed some deposit in bank. I've had 1 lakh rupees. I've deposited with HDFC Bank. Is it a personal account? Can I replace it with HDFC Bank? Then what will you put it as? Instead of bank, can't you put it as HDFC Bank? Huh? Yes, no. See, what is it? It is nothing but money receivable from HDFC Bank. You have deposited the money with them. Can you replace it with HDFC Bank name? Yes. So that is a personal account only. All of you? If you can replace it with the name, done. It's a personal account. Now, if you have deposited it with the bank, you can replace it as HDFC Bank. So it's a personal account. Okay. Stock. What is stock? Can you replace it with a name? I've purchased these dusters from Nagraj. Can I say Nagraj account? No. I should call dusters only. I should call them inventory only. So it is nominal account. Huh? No, it is real account. Anything which is not coming in personal account is real account. Land and all the tangible, intangible items like furniture, real account. Your goodwill, real account. Your anything, plant and machinery, gold, all these are what? Real account. Correct. Huh? Anything, real account is like a residual account. Anything which is not nominal or personal will come under real account. Now, what is the rule for personal account? Debit the receiver and credit the giver. Rule for real account? Debit what comes in and credit what goes out. These are the different rules and classifications. If you can understand classification under this rule, enough. Okay, that is only the last. And then I told you. So if it is stock, which account? Real account. If it is bank, personal account. If it is capital, personal account. Can I replace it with name? Yes. You can replace it with the name of the owner. It's a personal account. Then drawings, personal. Then what? Furniture, real account. Rent, rent payable is personal account. Rent as an expense is a nominal account. Rent payable is a liability that comes under personal account. Salary payable, understanding the difference. Creditors, personal account, because you can replace it with a name. So this classification, if you know, it is enough. So how do you draft a journal entry by using golden rules of accounting? Say suppose I'll take one transaction. Proprietor invested rupees 5 lakh in the business. So now we are learning how to actually frame journal entry. Okay. Now you have tried to find the two aspects here. Whenever you invest capital, what are the two aspects? Whenever someone is and you have to keep in mind separate entity concept. Whenever you are thinking for journal entry, you should think yourself to be business, not owner. Now, from business angle, whenever someone invests money, what will happen? Money is coming, and what is one more thing happening? My liability towards owner is increasing. Correct. So two aspects is cash and capital. Cash is a real account, and the rule is debit what comes in. So what is coming in? Cash is coming in. So cash account, debit. And capital is a personal account. What is the rule? Debit the receiver, credit the giver. Who is giving me money? Owner. So credit is account. Capital account. Or owner's name also you can put. 5 lakh. 5 lakh. Then understanding how we frame journal entry in golden rules. But how much ever you don't know about golden rules now, that much is only enough. Don't focus on golden rules. I don't agree. It's not a good way. Good rules to learn accounts. The better rules is traditional approach. Okay. Even if you have not understood golden rules, forget it. Focus on this rule. Okay. In modern approach, only 5 things you should know: asset, expense, income, liability, capital. If you know these 5 items, enough. Whenever a transaction comes, try to find out 2 aspects out of these 5 aspects: asset, expense, income, liability, capital. In transaction only, try to find out 2 out of these 5. If I have to take the same example, proprietor invested 5 lakh rupees as capital. So what is the 2 aspects? Cash is an asset, capital. 2 aspects we got. Okay, once you find out these 2 aspects, you have to follow my rule. The rule is, if it is asset in the transaction, if it is asset or expense increasing, debit. If it is asset or expense decreasing, credit. One more, if it is income or liability or capital, if it is increasing, credit. If it is decreasing, debit. This is all the rules you should know. Okay. Now in this transaction, what happened? Cash is an asset increasing, debit. Capital is increasing, credit. That's all. See, this is simple. Why do all that real nominal nonsense? Okay, it's okay. Know it for the classification purpose. For your drafting, use this one. Even till today, I use this one. Okay. So let's come to the second transaction. From now on, we'll use the second method. Golden rules is done. Only for purpose of classification. We made purchase of 2 lakh. So purchase is what? Purchase is an expense. Expense increasing? So purchase account debit. How much? 2. What is decreasing? My cash is decreasing. Asset decreasing, credit to cash account. 2 lakh. 2 lakh. Then third one, sales. Sales is an income. One more aspect is cash is coming in. So cash is an asset increasing, debit. Sales is an income increasing, credit. So how much? 3 lakh. 3 lakh. Done now. Fourth transaction. Purchase of furniture. You're purchasing a furniture. So asset is increasing, furniture. Then what is decreasing? Cash is an asset decreasing. So furniture asset increasing, debit. Cash is decreasing, credit. Furniture to cash. How much? 1 lakh. 1 lakh. 1 lakh. Then we have paid rent. Rent is an expense. Then what is decreasing? Cash. So rent is an expense increasing, debit. So rent account, debit. So cash is an asset decreasing, credit. How much? 50K. So understanding how we are doing journal entries. Take a transaction, find 2 aspects. If it is increasing or decreasing, you see. If it's asset expense increasing, debit, decreasing credit. If it's income liability, capital increasing credit, decreasing debit. Now what you have to do after going home? There are a lot of exercises in journal entries. Correct? You have to do them. Okay, we'll do some of them, the tricky ones. Okay, but what you have to do? You have to do the remaining, and if you have any doubts, you have to come back. Clear? Done. So here I'm focusing on showing the flow. Okay, so let's understand the flow. Now did we record journal entry?
Yes.
Yeah, for all the 5 transactions, we recorded journal entries. Okay, the second step is done. Third step, ledger. In ledger, what we'll do? Whatever. One more thing, we'll discuss it off more. Now, whenever transaction happens, you recorded it where? You record it in journal entry, which can also be called as journal proper. If you are recording something as a journal entry, it will be recorded in journal proper. Sometimes what we do, there are certain transactions where the volume is very high. For example, take purchase. What, in an entity only one purchase will happen? No, many purchases will happen. Do you think every time purchase happens, I should be doing purchases to creditors, purchases to creditors, purchases to creditors? What should I do, the business or do journal entry? So that's why what they have done is, whenever there is volume of transactions is more with respect to some transactions, we use subsidiary books. Andre, we record all these transactions directly in subsidiary books. You know the format of subsidiary book? Yeah, normal. Okay, you directly record the transaction in there. You're not passing any journal entry. You just record it in subsidiary book. Now, which are the examples of subsidiary book? We have purchase book, sales book, purchase returns book, sales return book. Then we have journal proper also. Then we have bills receivable, bills payable. Then we have cash book also. These are called even journal proper. All these are called subsidiary books. Okay. Also known as books of original entry. Why are they called books of original entry? The transactions are recorded first time where? In subsidiary books. See, if it is purchase returns, BP, BR, it will come in those books. Any entries which cannot come in these books will come in journal proper. Example, depreciation entries. You know what is the entry for depreciation? Depreciation account debit to machinery. Where will it come in? Purchase book? Purchase return book? No. For that, some book should be there. No? Will it come in cash book? Hey, depreciation is a non-cash expenditure. So where will it come? It will come in journal proper as a journal entry. So journal proper is a residual. All the purchase, sales, BRBP, anything which is in the nature of credit will only come in subsidiary books. All of you know this, only credit transactions will come in subsidiary books. Will credit sale come in sales book? Yes. Credit purchase will come in? Cash sales will come in? Cash book. We have cash book, no? We have a separate cash book for recording cash transactions. Then why take tension? Correct. So that's why only credit transactions will come in these books. Cash transactions will come in cash book. Clear? So one way to record transaction is subsidiary book. One more is journal proper. In journal proper, direct entry will pass. In subsidiary books, we just record it. From subsidiary books, it will directly go to ledger. After putting in subsidiary books, will we again pass journal entry? No, very important point to know, guys. Once it goes to subsidiary books, it will directly go to ledger posting. It will not, again, journal entry will not pass. I thought only in journal proper will pass journal entry. Clear? Now, once the journal entry is recorded, either via subsidiary books or in journal proper, next we'll go to ledger. Okay. So in ledger, what will I do? I'm trying to classify the transactions. Okay, what I do is whatever ledger accounts I've used in journal, I will put it here. Now tell me which are the accounts that I've used. First, I've used cash account. I've used then I've used capital account. Then I've used purchase account. Then I've used sales account. Then I've used furniture account. Then I've used rent account. Then LIC. Purchase, sales, furniture, rent, cash, capital. That's all. So I've opened ledger account for every account that I've used. Now how to post this into ledger? What you have to do is first go to journal entry. Cash account, debit to capital account. You see the journal. Let's start with cash. So cash account. Here we have cash ledger. Okay. What you have to do is in the journal entry, if it is debited, then in the ledger also it should come in debit side. You know, debit is left side, credit is right side. So if it is debited, if this account, cash account is debited in the journal, it should also debit in its ledger. So that means if this is the entry, cash account, which side it should come? Debit side. As what? As the other opposite account. What is the opposite account? So to capital account, it is 5 lakh. One more entry should come in capital also. Capital account is credited in the journal entry. So here also it should be credited. So by the other account is cash. 5 lakhs. Understood how we post the ledgers? Now, next entry will post. Purchases to cash. Purchase. So in the entry, purchases is debited. So to cash. Here, how much is the purchase? So 2 lakh. 2 lakh. And in cash, cash is credited in the journal entry. So it will come in by purchase 2 lakhs. Then sales we have done. Cash to sales. Cash is debited. So to sales 3 lakh. Again in sales account. Then furniture to cash. Then furniture is debited. So to cash 1 lakh. Then in cash is credited. So by furniture. How much? 1 lakh. Then rent is paid. Rent to cash. So to cash 50k. Then in cash account Done. We are done with. Are we done with ledger posting? No. We still have to balance the accounts. Now, how to balance the accounts? Now, if the ledger accounts are of the balance sheet items nature, then you will balance it. Andre, either if it is asset or liability, what will you do? Balance it. Andre, if debit is more than credit, then balance will be debit balance. What you have to do? Let's try to balance cash account. Now, cash account is what? It's a balance sheet. It's an asset item. So, will it go to P&L? It will be there in balance sheet. If it is income or expense natured account, we will not balance it. We'll transfer it to P&L because it should go for the calculation of profit and loss. Now, this is an asset account. How will you balance it? Out of the two sides, take the greater side. Which is the greater? Debit side. Add and subtract all the credit side. So 8 minus 2 minus 1. It is 4 lakh. So if you're since you are carrying forward the balance to the next year, it comes as balance carried forward. Why are we carrying forward, guys? These are assets. The benefit for assets will come over many years. So I want to retain the balance. That's why I'm transferring the balance to carrying the balance to next year. So how much it is? 4. Capital is what? Balance sheet item. Huh? Yes. So you will balance. So 2 carry it down. How much I'll carry? 5. Then purchase is what? Nominal expense account. We transfer it to P&L 2 lakh. Sales is what? To P&L it is. Then furniture. Then rent. Now the ledger posting is complete. We balanced and transferred it to P&L. All of you clear till here? Okay. Now let's come back to the subsidiary books. Now what is happening? From journal we posted everything to ledger. Okay. How will subsidiary books be? Now journal entry, you know how we posted. How will something recorded in subsidiary books be posted to ledger? Total. So what will happen? Say suppose it is purchases. If I pass a journal entry like this in journal proper, then okay. What if I have recorded this purchase? This I cannot record. Say suppose it's a credit purchase. So credit purchase, I have recorded it in purchase book. So how will I post that to ledger next? Because I will not pass any journal entry. So I'll tell you how. So what will be the format of purchase book? Something, it will be like this, okay. Date, particulars, amount, something like this. So say suppose from credit purchase happens on 1st January. From whom? From Mehta. What did I purchase? Chudidar. For how much? 50,000. Then what happened? Then on 2nd, from tell some name. Samarth. From Samarth, I purchased chaddi. Okay. So it is worth 50,000. Correct. So whenever credit purchase is happening, what am I doing? I'm simply recording it like this. Am I passing any journal entries? No. Then I told you from subsidiary books directly it will go to ledger. Then how will it go to ledger if there is no journal entry? What we'll do is we'll take the total. What will we do? We'll take the total purchases in the purchase book. I thought 1 lakh. I'll directly go to purchase ledger and I will put it in which side? I'll put it in debit side as to Sunday creditors. How much? 1 lakh. Because purchase is an expense, increasing debit. Correct. Next, what will I do? Then I'll go to Mehta. I'll again go to purchase book. I'll see Mehta's total. How much is Mehta's total? 50,000. So Mehta is a creditor. Creditor is a liability. Liability increasing credit side. So I would have posted it in credit side. So by then we have Samarth. So he's also a creditor. Liability is increasing. I will credit. So by clear. Understanding what I'm doing? First, I'll take the purchase total, put it in purchase ledger. Why am I putting in debit side? Because purchase is a expense. Expense increasing debit. Simple. Creditor is a liability. Liability increasing credit. So if I'm entering it in subsidiary books, this is how I do ledger posting. If I record a journal entry, I will record it like this. How we learned. Okay. Now in subsidiary books, we have one book called as cash book. Okay. What is the format? Format of cash book?
Discount date.
Normal cash book. It is date particulars rupees, receipt, date particulars rupees, payment. Left side receipt, right side payment. Don't you think the format of cash book is exactly same as ledger?
Yes.
Right? If you go to ledger also, format is same. Date particulars amount, debit, credit. If you go to cash book, format is same. Date particulars amount, date particulars amount. So you know what accounts people did? Hey, if you see cash book format is also same. Ledger format is also same. We'll do one thing. Those who maintain cash book, no need to maintain cash ledger account. Because both are same. Right? Now, the thing is, subsidiary books are secondary books. Then what are primary books? Ledger book is there, no? That is the primary book. All other subsidiary books are secondary book. Okay? That's why it's called subsidiary books. Main books are called principal books. That is only one book. That is ledger. Ledger is the only principal book. Rest all is subsidiary books. Clear? Now tell me, is cash book a ledger? Is it a principal book or subsidiary book? Tell me anything. It's okay, even if you're wrong. It's why? Because I told ledger is the only principal book that we have in Yaduina. All the other subsidiary book. What is journal proper? Subsidiary book. Cash book, subsidiary book. Purchase book, subsidiary. Sales book, subsidiary. Cash book is also subsidiary. Cash book is both subsidiary and principal book. Why? Because cash book is also a subsidiary book. Then accounts people told, if they are maintaining cash book, no need to maintain ledger. Then it is also as good as ledger account. So cash book is the only book which is both principal and subsidiary. By nature, cash book is a subsidiary book. But since accounts people told, if you are maintaining cash book, no need to maintain ledger account. It is also as good as ledger. So cash book is the only both principal and subsidiary. Then rest all is either subsidiary. Journal proper is what? Subsidiary. Purchase returns book. Purchase book. Journal proper. Cash book. Both. Ledger. Principal. Understood? Rest all is subsidiary. Understanding? So we are done with ledger posting. That is the second. Now whichever you have balanced, that will go to balance sheet. Whichever you have transferred to P&L will go to P&L account. Simple. Correct now? Now let's go to trial balance. What is this trial balance? Nonsense. Trial balance is not at all, first of all, part of accounts. See, since we follow dual aspect method of accounting, that means for every debit we have a credit. Right? Before going to the account, these accounts people wanted to check whether we have done the accounts correct or not. So what we'll do is, we'll prepare one trial balance. The format of trial balance is particulars, debit, credit. We'll put all the accounts that we have opened in particulars. If that account has a debit balance, we'll put it in debit side. If that account has a credit balance, we'll put it in credit side. That's all. And ultimately we see. If it is matching, that means mostly we have done our accounts correctly. Our debit is equal to credit means we have done the accounts. Mostly we have done the accounts correctly. Right? That is what we are doing in trial balance. Before going to trial balance, how to decide whether an account is debit balance or credit balance? There are 3 rules in mind. This thing. First rule, if they have given you the ledger account, what you have to do? See which side is greater. If debit side is greater, that account has a debit balance. If credit side is greater, that account has a. If the ledger account is given. If the ledger account is not given, they have just given the name. Then how to decide? Imagine your balance sheet. Simple. See the balance sheet. If that account comes in asset side, it has debit balance. If that account comes in liability side, it has credit balance. For example, creditor. Which balance? Loan? Furniture? Cash in bank? Simple. Capital? That's all. Simple. If nothing is given, see where it is coming. Okay. Then one more method. If it is nominal account, what to do? If it is expense, it has a debit balance. If it is income, it has a credit balance. Rent, Rent received, then rent paid, ashte. Classification is simple. Okay. Rent payable, liability. So it's a credit balance. That's all. So this is how you classify if just name is given. Okay. Or one more thing. See, you know what basis I am doing this? You have to take the account, see the nature. For increase, if it is getting debited, it is debit balance. Take the account. For increase, if it is getting credited, it's a credit balance. For example, loans. For increase, what will we do? It's a credit balance. Like that also you can. I think the second method is better. Okay. Now let's do the trial balance posting. Let's post all the debit balances and credit balances. So to maintain trial balance also we have two methods. One is total method, one more is balance method. In balance method, what we'll do? I'll give you one. Okay. Now what we'll do is prepare a trial balance. So particulars, debit, credit. Okay. This is trial balance. What we'll do is go to all the ledger accounts, collect the balances. The first one, we'll go to cash. How much is the balance in cash?
1.5.
It has debit balance and credit balance. See, which method you have to use? Here they have given the ledger account. So that means you have to see which side is more. Debit side is only more. So it has a debit balance. So first, cash account has the debit balance of 4 point. Then,
Next year, if you bring it down, we have a debit balance.
no doubt, it still be credit. The only thing is what we'll do is carry it down comes here, alva. Then the opening balance for the next year comes like this 2.
That is debit balance.
No, still debit balance. It's coming in the debit side. Opening balance came in the debit side. For debit balance accounts, opening balance will come in debit side. Debit side. Since you are carrying forward the excess, it's coming in the opposite side. Carry it down will come in the opposite side. When you bring it down, it will come to the nature. Debit. So, if it is a debit balance natured account, where will opening balance come? Debit side. If it's a credit balance natured account, where will opening balance come? Credit side. Simple. Okay. The carried down will come in the opposite side. Bought down will again come in the same nature side. Okay. The next one is capital. Capital has a balance of credit balance, which will come in. Which side? Capital has which balance? Credit. So capital, how much?
5.
Then purchase.
Debit.
Purchase is an expense. Expense has the debit balance. So purchases. Then sales.
Credit.
Has the balance of credit 3 lakhs. Then
Furniture.
furniture is an asset.
Debit.
Debit. How much? 1 lakh. Then we have rent.
Debit.
Rent has a balance of, it's an expense, it will come in debit side. So it is 50. Anything else that we have left? Everything we have put. Now if you have done our accounts correctly, what should happen? Trial balance should tally. So let's see if it's tally. 4.558. This is 8. This is also
8.
9. Matching. That means we have done our accounts correctly. Mostly we have done it correctly. So we're done with trial balance. So what did we do in trial balance? Took all the ledger balances, put it in debit credit sides. We have other things, suspense and all, which will come. That we'll discuss separately in that unit. Now we'll see the flow. How will it reach the balance sheet? Then we'll immediately prepare the next part, which is final accounts. First is P&L. In P&L, what will happen? Income will come in credit side, and assets will come in expenses will come in debit side. So which are the incomes that we have? Now to prepare final accounts, I'm taking the help of. Will I again go to ledger? No, all the accounts is already there in trial balance. See here only, no. So which are the expenses we have? We have purchase. Purchase. How much we have? It's an expense. It will come this side. Then sales is what? Sales is a income. This will come this side. How much? 3 lakh. Then we have closing stock. Closing stock will come in both trading account and balance sheet. Correct? Where did I get closing stock? I went to go down, I counted it. Now I've got closing stock as rupees 1 lakh. 1 lakh. So it will come this side. Closing stock 1 lakh. So your gross profit is 4 to 2 lakhs. So rent will come in P&L. This is trading though. So 2 lakhs bought down. Rent is how much was that? 50k. So my net profit is 1.5 lakh. So I posted everything in P&L. So my net profit is, all of you clear? Then after P&L will create balance sheet. In balance sheet, simple assets and liabilities will come. So tell me all the assets that we have. We have furniture of 2 lakhs. Huh? We have furniture of what? 1 lakh rupees. Then we have closing stock of how much?
1 lakh.
1 lakh. Then we have cash of. Then we have capital of how much? See, we have capital of how much? 5 lakhs. 5 lakhs. Then I've told you the profits also belongs to owners. So I have to add. How much is current year profit?
1.5.
So total it became.
6.5.
Then what do I have? Furniture we have posted. Everything has come. Everything came. Now see. Now if we are done anything, what if the next thing what you have to do is you have to to pray to God. Then let the balance sheet tally. Okay. Once you pray, then you see it should tally. So it is. And so that means done. This is how your transaction from journal entry flows to balance sheet. So you understood this idea? This overall idea is very important to understand the next units that we do. Okay. That is about the flow. Okay. Now it is 1:56. So we are done for today. Okay. Now what you'll do is tomorrow we'll start with the journal entries and other stuff. We'll not solve everything, the important ones. Okay. So we'll do that tomorrow. What you have to do, meanwhile, whatever we have discussed, you should read it properly today. And if you have any doubts, come back with respect to the discussion that we have done till today. Okay, that is how you can make the better usage of this session. Or else 5 days will go like anything. There will be no use on it. Okay, here. Now this flow which I have told, no, it is very important. I want you to remember for later discussions also. Okay.